Hi, everybody. I'm here with Robert Brokamp today. My name is Buck Hartzell. Bro, we're here to talk about 401ks today. This is the 401k Focus Hour. I see questions in there about Canadian natural resources, tariffs, all kinds of stuff. We're not going to do that. We're going to talk about something that's near and dear to both of our hearts. We're both passionate, not only about the topic of retirement, but 401ks in general. And at least one of us is qualified to speak on those, and that's you. So thanks for joining me today. It's the Buck and Bro Show.
Thank you, Buck. And yes, welcome everyone to Fool24, watching us on the Motley Fool website or YouTube. And we will be answering your questions about 401ks, retirement planning. Go ahead and get those into Slido. If you're watching on the Fool Premium website, you should see Slido at the right. Get those questions in. We'll try to get to those questions. If you have any other sort of financial planning related questions, maybe you can get to those, but we are going to prioritize questions about retirement planning and making the most of your 401k. Buck, you want to tell the story of why you and I are at least joined at the hip when it comes to 401ks?
Yeah, besides having families that get along and raising kids together, we've worked at the Fool for over a quarter of a century now. And back when we started, we're talking about the late 1990s here. We came in, and I think there were a few of us that looked at the 401k plan and didn't love the options that we had at that time. Keep in mind, we were a very small startup company with not a whole lot of assets as well. And some of us started asking questions, and we eventually went to our provider and said, hey, we don't like these choices. We need to upgrade them. And they looked at us and said, sorry, we can't do that. So we went back, got a bunch of other options that were better than what we had, and said, hey, we'd like these. And they said, sorry, we can't do that. And so a group of us, that's you and myself and Barry Chambers as well, we got together and formed the first 401k committee. And we've been doing that for a quarter of a century since then. And I think we've upgraded our plan significantly. And I think it's one of the kind of labors of love that a few of us, not just you and I, but a few fools have done that realize that the 401k is a really important savings vehicle for so many people, maybe the most important one that most workers have. And it's important that you work at a place that has a good one. And if you do have a 401k plan, it's important that you make the right decisions with that money. So we're going to talk about some of those, but I want to kind of just jump into it. So we're starting from a good base here. And let's just talk about 2025. It's a relatively new year. We just turned the corner. What are the actual contribution limits for folks that are out there participating and have the option of a 401k at their work?
I'm going to share my screen and do a little bit of a presentation. So as we talk about this, you have some numbers in front of you, and hopefully they will pop up soon. Doing a PowerPoint, but let's go into the contribution limits for this year. Now, you're probably familiar with what I'm calling the standard limit. And this is the amount that anyone in any sort of defined contribution plan, and Buck and I are going to be talking about 401ks, but most of what we're talking about also applies to other plans such as 403bs. Maybe you are a federal employee and you participate in the thrift savings plan or the TSB. Most of what we're talking about will also apply to those. So there's the limit of what you can put in. I'm calling the standard limit. It's $23,500 if you're 49 or younger. And these ages, by the way, are determined by your age on December 31st. So if you're 49 right now, but you'll be 50 by December 31st, you can do these higher limits. And those higher limits are called the catch-up limits. And for years, we've had one catch-up limit, and it was for anyone who was 50 or older. And you can see that that limit is $7,500 for people who are between 50 and 59 and 64 and older. This year, there is a new catch-up, which some people are calling the super catch-up. And that is $11,250 for anyone who's between 60 and 63.
So I want to qualify something real quick, Robert.
Yep.
So that you said December 31st, that's of 2025. So
yes.
What we'll be clear about here is you can turn that age anytime throughout 2025, and you can contribute that extra, and you can start doing it even before your birthday happens.
Actually, yep, that's exactly true.
Okay.
And also, I want to make the point that this is the amount that you can contribute. The match is on top of that. So if you get an employer match, and most people do these days, the most popular formula is 50 cents on the dollar up to a contribution rate of 6%. So the average match in the US, you should contribute 6, your employer will put in 3. So if you're getting above that, that's good for you. If you're getting below that, might be something you want to talk to your employer about. But so the match is on top of what you're seeing there for the standard limit. Now, there is something else, which I'm calling the all-in limit. And that is the total amount that can be contributed to your 401k, including the standard limit and a match that your employer puts in. Sometimes an employer will put in a profit sharing amount in there. And then on top of that, if your plan allows it, and most don't, but you can ask about it, there's something called after-tax contributions. So not to be confused with the Roth, because the Roth is also technically after-tax. The after-tax, you go in beyond the traditional and the Roth. Because it's after-tax, you don't get a tax deduction, but the investments do grow tax-deferred. So there is a benefit to that. Now, there is something else that you can do. Maybe, again, if your plan allows it, you can automatically convert the after-tax contributions to Roth. So you put that after-tax money in, automatically convert it, immediately becomes a Roth contribution. This has become known as the mega backdoor Roth. Again, it's not available to most people because your plan has to allow, number one, Roth accounts in general. Most do, but not all do. After-tax contributions, most don't allow that, and the in-plan Roth transfer or in-plan Roth conversion. But really, there's no reason for your employer not to do it. So as we go through this presentation, Buck and I will talk about good features that should be part of a good plan that you can talk to your employer and provider and see if they can add that. Anything you want to add to that, Buck?
Right. And so I'd say the Roth is interesting, and I'll just go back a little bit. We have a Roth 401k for our plan. We don't pay extra for that, as Robert said. So for those of you who are going, to your employer, say, hey, we've heard that this is an option if you don't have it, and it doesn't cost you anything extra. At least that's what we've heard from the Motley Fool, and having them answer that question. The other thing I'd say is about the Roth, which is important to understand, is if you do a Roth IRA, and let's say you've been working and you start to get raises, there are, actual income limits for a Roth IRA. And that's one way, that mega backdoor, which Robert said, if you earn over a certain amount, you might not be able to do a Roth IRA, but you could do after-tax contributions and convert those into your Roth 401k. So that's a tax advantage for folks that may be higher income earners.
Yeah, very, very good point, because there are income limits on the Roth IRA, not for the Roth 401k, not for after-tax, not for the mega backdoor. So anyone could contribute to a Roth 401k account. And since we brought up traditional versus Roth, I thought we'd clarify a little bit of what we mean by those. So with the traditional, we mean the traditional because it's been around since 1978, which is when the law that was passed that created the 401k. The money goes in pre-tax, so you get a tax break today by making those contributions. The money grows tax deferred throughout your years as you're working, meaning you don't have to worry about paying taxes on the interest, capital gains, or dividends. That means leave more in your money in your account to grow. But then when you take the money out, you pay taxes. So tax break today, pay taxes in the future. Roth is the other way around. Roth, named after Senator William Roth of Delaware, passed away in 2003. No tax break today. You do get the tax deferred growth, so you don't have to worry about the taxes on what's going on inside the account. Then you take the money out and it is tax-free as long as you follow the rules. And the basic rules are you have to be 59 and a half, and the account has to have been open for at least 5 years. So which one should you do? Well, I have this graphic here from Michael Kitces, a financial planning expert, I think is a good visual representation of the choice. So you got a couple of seesaws, teeter-totters, depending on where you grew up. That's the name you'll use for that thing. So if you are in a higher tax bracket today, and you'll think you'll be in a lower tax bracket in the future, go with the traditional because you want to take the tax break today because you're in a higher tax bracket. Now, if on the other hand, if you're in a lower tax bracket today, and we're getting a visit here from my dog on the right there, now the dog's leaving. If you're in a lower tax bracket today, but you expect to be in a higher tax bracket in the future, because you're going to be so smart and you're such a good investor, you're going to have so much money. Or maybe you think because tax rates are going to be higher in the future, I'm not going to give an opinion on that, but just something to think into your own decision, then go with the Roth. And the final thing I'll point out about this and then see what Buck has to say, it's not an either or decision, right? You can contribute to both the Roth and the traditional in your account as long as the combined amount does not exceed the annual contribution limits. Buck, what are your thoughts on traditional versus Roth?
So, I mean, and I know you talk a lot to newer employees at the Motley Fool. And I just say, like, a good rule of thumb is if you're younger and you're in a lower tax bracket now, it's probably a pretty good decision to think about doing the Roth a 401k. And I would add, we're making this almost as an either or decision, the way you discussed it, but it's not. You can actually, split in many plans. You can put a portion of it into traditional, and you can put a portion into the Roth 401k if you'd like, if you can't decide. But I'd say the younger you skew with the lower tax rate you have now, that's a good thing to consider, certainly, for doing so. The other thing I would say is if you're not sure what you want to do later on, a lot of those Roth 401ks have kind of a time clicking on it. So they a Roth 401k. They don't work like an IRA. So it's kind of important to early on just make your first contribution, at least one, into that Roth 401k. Then if you decide you don't want to do it, you can just go back to the traditional, but at least it starts a clock ticking, which is important in some 401k plans, but that's specific to their plan. So I'd say everyone should consider at least making one contribution to that 401k plan. And I'll make one more thought about taxes. I'm not going to make a prediction on tax rates in the future either. That's hard to do, but I will add some color around that I think is pretty important. One part of that color is we're running $2 trillion deficits here in the United States, and we're running them as far as the eye can see. Like there's no balanced budget that we can see into the future, and I think that's a pretty safe claim. The other thing I'd say is I was at the Berkshire Hathaway meeting last May, and people asked Warren Buffett about his decision to sell Apple shares. And since that time, he sold about 600 million shares of Apple Computer. He now has over $325 billion of cash at Berkshire Hathaway. It's mostly in treasury bills. And he said this: tax rates are going up. And I think tax rates are going up for long-term gains on stocks. And so I'm willing to take these and pay the taxes now, take the long-term gains, just because I don't think there's any course, but that interest rates, or not interest rates, but taxes will be going up. So that was one person's decision. He made that decision, as he said at the meeting, solely based on where he thinks tax rates are going. And he's a pretty smart person. So maybe that's some important context there, although I won't make a prediction either. That's one person's opinion, and it's a pretty smart one.
Thank you for that. And I just want to highlight something else, piggybacking a little bit on what Buck said. If you have a Roth 401k at your work and you've been there, let's say 10 years, right? You've met the 5-year rules. But then if you want to then retire or whatever and transfer it to a Roth IRA, and that's your first Roth IRA, the 5-year clock starts all over again. So you might want to open up a little Roth IRA too to get that clock going.
Yep, that's a great idea. Okay, so we've talked about some different options that you have in there. And I think here's like an important thing, particularly if some folks, we'll talk about tax rates, tax brackets first. And then I want to also ask, how much should people save, Robert? Because people who are listening here, they may have children that are graduating from college this year. Some of them, I do, and younger folks in general, and also maybe even themselves. But we'll talk about a little bit more, like when people are getting started, how much is the right amount to save so that you can be sure, or relatively sure, that when you get to retirement, you have the funds and means to do what you want. But first of all, let's talk about brackets here.
Yeah, and I just wanted to throw this picture up of the brackets, because in the discussion of the Roth, we talk about whether you're in a higher tax bracket or a lower tax bracket. And I think a lot of people are like, well, I don't even know what my tax bracket is. So I just like to throw this up so you can see your taxes are based on your taxable income. So you start with your gross, then minus your deductions. Most people these days take the standard deduction, which in 2025 is $15,000 per person, $30,000 if you're married. Then you get your taxable. So that will give you an idea, for example, just to see a little bit of what tax bracket you are in today, and maybe think a little bit about where you'll be in the future. But to get to Buck's question in terms about a saving, these days, the rule of thumb, I think, if you look at any analysis, it's that you should be saving 15% of your household income. And that would include the match. So here at the Motley Fool, if you contribute 9% to our 401k, the Fool match is 6%. So you hit that 15%. To the right there, you see an illustration from Fidelity, and lots of firms, Fidelity, T. Rowe Price, JP Morgan, Asset Management, even Vanguard, will have some rough guidelines of how much you should be saving and how much you should have already saved. And I'm going to talk a little bit about that on the next slide. But this illustration from Fidelity shows their guidance for someone who's 25 should be 15%. Well, that percentage goes up the longer you wait. So, if you don't start saving until your 30s, the amount you have to save if you want to retire around your mid 60s goes up. So the sooner you start, the better. I would say that I totally agree with Fidelity's 15%. Their other numbers there seem pretty high, but the analysis behind it is pretty good. But if you were to look at some suggestions from, like, for example, JP Morgan Asset Management, the numbers would be a little lower. But one principle of retirement planning, I've been writing about retirement now for over 20 years. And one thing that has evolved in my view of retirement is around a quarter to a third of people retire sooner than they expected, either due to health issues of their own or their spouse, and they have to stop working to take care of their spouse, or they get laid off and have trouble finding another job. We're seeing that already in today's economy. So I think it makes sense actually to be very aggressive with your savings while you can, because you don't know if you're going to be able to work as long as you expect. And then we also have a little rule of thumb up there, and it's based on the 4% rule, which I think is still a good starting point for a safe withdrawal rate in retirement. And so you basically estimate your required income in retirement, how much you're going to need. You have to adjust it for inflation, especially if you're a good 5, 10 or more years away from retirement. You subtract your non-portfolio income, such as Social Security, pension, business, something like that. And then you multiply that by 25, which is like mathematically the inverse of 4%. I don't know if that's the right mathematical term, but that's the point. So, if you think you need, let's just say, whatever, $80,000 a year in retirement, and you're going to get $30,000 from Social Security, you multiply 50,000 by 25, and that's how much you need before you can retire. Buck, your thoughts?
Yeah, so that gets you to 1.25 million, and I think that's a very good rule of thumb. And we'll talk about some strategies for withdrawals too, which I think can help. We talked about that 4% withdrawal rate is the amount you can safely take out. There's been articles, as we all know, and you've written about this a lot, Robert, that says, hey, that's dead. Now you can take 5%, or it's 4.5%, or whatever it is. But I think that 4% is a pretty conservative number to think about. And I would just sum up 2 points from how much should you save. I think that 15% of your income is a really good rule. I would also add, when you're younger and just starting out, save till it hurts. Like, you don't have kids and all these other things that go along with it. You're just starting, and you're going to make more and more money throughout your life. If you can delay the purchase of that sweet car that you've been wanting to get, or apartment or whatever else, and sock that money away early on, you're going to be at such a big advantage. And I would encourage your children and things to do the same. Maybe as parents or grandparents, you can even provide a financial incentive. Something we did at a very early age for our kids and continue to do is kind of match a portion of their savings, be their own 401k match that you can kind of give to them to encourage them to do the right behaviors. Because if they get off on that right track, it's a great thing. The last thing I would say, Robert, we've had discussions about people that get out of college and say, I need to pay down my college debt. That's my very first thing, or I want to do something else with my money. If you have a match from your employer, that's free money. I put that ahead of everything. Maybe high interest credit card debt I would pay off first, but free money is something you don't give up. And so I encourage anybody that's giving advice to somebody who has a 401k, if they have a match, at least participate up to that match point.
Yeah, a good point, because you not only get the match, but as we mentioned previously, there are, of course, the tax benefits as well.
Yep.
So let's say you have been saving. You might be curious, am I on track? And as I mentioned, many firms offer sort of these guidelines. These are the guidelines from T. Rowe Price. I like them because they're a little more modest at the beginning, recognizing that when people enter the workforce, they might have those school loans, or they might be trying to buy a house and build and create a family and all that. So they may not be able to save as much, but they ramp up more as you get along the line. So let me explain how these work. So it's basically a multiple of your household income. So just as an example, let's say you are 50 years old and your household income is $100,000. T. Rowe Price thinks you should have 5 times that saved by now, or $500,000. Now, this is very general. You should not take this as the end-all, be-all verdict on whether you're saving enough. You should get an analysis based on your unique circumstances. a high quality retirement calculator, for example, or I recommend that everyone should see a fee only financial planner every few years. But they say that in general, for the average person, and that average is represented by this line in the middle here, they should have about 11 times their pre-tax income before they retire. But then you'll notice that they have these ranges, right? And that's because different people have different circumstances that would warrant needing less or more money. And there's a whole report about this, but I'll just highlight a few of the things. First of all, of course, if you enter retirement without a mortgage, you don't need to have much saved. If you are going to get a solid defined benefit pension, you don't need to have as much saved. One principle is that the more money you make, the more you have to save, because you're going to get less help from Social Security. The way Social Security is designed it's designed to replace more pre-retirement income for lower income Americans. So just as a broad example, if over the course of your life, you earned on average $50,000 a year adjusted for inflation, because Social Security is based on your 35 highest earning years. If your career on average was $50,000 a year, Social Security will replace about 45% of that. If, on the other hand, over the course of your career, you earned about $150,000, Social Security will replace somewhere between 20 and 25% of that. So the more you earn, the more you have to save, because the less help you're going to get from Social Security. So again, these are just broad guidelines. Highly recommend that you get an analysis based on your unique situation, but I think they're a good starting point.
I have one follow-up question, because I know, Robert, a lot of people in America own a home. Yep. And some of them have home equity, and some people kind of count on that maybe down the road as part of a savings. So would you include home equity as part of your savings? Or are you just talking about savings that you've put away in kind of liquid assets like stocks and in retirement accounts?
Yes, I would say it's the latter. And I would assume that's also the case here for this T. Rowe Price analysis. We're just talking about what you have your IRAs, 401ks, cash, brokerage account. Right. That said, if part of your plan is to downsize in retirement, right? Maybe over the course of your career, you worked in a higher cost area, you had a bigger house because you raised a family, but when you retire, you plan to sell your house, move to maybe a lower cost area, maybe move to a smaller house and realize a good few $100,000, then I think it's reasonable to include that, but only if you are definitely going to do it. The way I think of home equity, because I plan to stay in this house for a long time, it's just a big fat backup emergency fund for my retirement. So if for something happens to my portfolio, I can access the home equity maybe through a reverse mortgage, maybe if backup for long-term care. But that's how I think about it. What do you think about, Buck, in terms of your home equity?
In home equity, to me, I've never treated my home as an investment. Right? It's a place I live. It provides comfort. It's fun. It's nice. I like to have a home. And there's some tax advantages to doing so for folks that don't have a home. There's some write-offs and stuff for mortgage interest and that kind of thing. And we have a luxury here. I work on our Canadian services as well as the United States ones. And in Canada, they don't have the luxury of getting a 30-year fixed mortgage. Right? They call us socialists up there, right? When I talk to some of our colleagues up in Canada, right? They have to, every 5 years, they have to revisit that mortgage. So we have some things that are pretty nice about owning, but I've never considered it an investment. It's not one that I plan to tap or use, but it's a nice thing to have, and it's extra. And what I would say for most folks, and I think, we live in the Alexandria, Virginia area here near Washington, D.C. It's a relatively expensive place to live in the country. It's not like San Francisco or New York City, but it's kind of expensive. And I think a lot of us probably plan to say, hey, we like this area, but, after we're done working and maybe we'll move somewhere a little less expensive, and we can roll that home equity and maybe buy something for cash, and you don't have to worry about a mortgage when you're in retirement, because that's a nice place to be.
Yeah, very, very well said.
So I want to talk about some investments here. So we've got some good backup stuff, and then we're going to take some questions. I see questions are already rolling in, but I want to talk about like what options, what should you consider as a good investment option within the 401k plan? And is there a single investment choice that you can make? Let's say you don't love following this stuff. You don't love investing. Is there one investment that you can make and just forget about it, set it and forget it?
Yeah. So let's talk about target date funds. This is basically, as I say there, a one-stop shop. This is a way to essentially hire someone to manage your portfolio at a very low and reasonable cost. these days, the vast majority of 401k plans do offer target date funds. And by far, they are the number one choice, partially because more and more 401ks are auto-enrolling people. And when you auto-enroll your employees, you have to choose an investment. And the Department of Labor has said, if you auto-enroll your employees and you put them in a target date fund, that is a prudent choice and your employees can't sue you. So what is a target date fund? It's essentially a mutual fund that owns other mutual funds. And it's going to be a prudent mix of cash, stocks, and bonds based on that future retirement date. So if you were looking at for example, you can see there on the screen, what I have on the screen there are the average allocations I looked at the target date funds from BlackRock, Fidelity, T. Rowe Price, and Vanguard, which are among the largest providers. This is as of January of this year. 2025 fund, right? We're talking decades, 92% in the stock market. But as you get dates that are closer, including 2025, which would mean someone who's retiring this year, you are down to 46% stocks. And it does all the rebalancing for you. And it's going to be a mix of not only cash and bonds and stocks, but it's going to be US stocks, international stocks, small cap stocks, large cap stocks. The bonds will be treasuries, corporates, and some international stocks. But as you get closer to the retirement date, they start selling off some of those types of stocks and bonds that are a little riskier. So for example, the 2055 fund will have more international exposure than the 2025 fund. So it's a great one-stop shop if you're not quite familiar with investing yet, or you like picking stocks, you do all the things we do here at the Motley Fool, but you will have one portion of your portfolio that's just sort of a set it and forget it part. And I, as a Motley Fool employee for more than 25 years, do have a little bit of my money for my wife and me in target date funds.
And I would say, if we look at all the target date funds within the Motley Fool universe in our retirement plan, they're the most popular option. If you add all those up, and that's where a lot of newer folks, and it's a good option. It's diversified across many classes, as Robert said, and it auto rebalances for you as you get closer to that date. So that's a nice option for folks to have. Our single biggest option within our 401k plan is the S&P 500. It's actually the total market index now, not the 500, but and it's been around as an option for a long time for fools. So it's just a single class. There's a lot of people that have that in there. Okay, so that's a great thing. So we talked about one investment choice. I'm going to do one more and we're going to get to questions here. Let's talk about when you leave. And we have some questions in there about rollover and what happens when you leave a job. What should you do with your money?
Yeah, so it depends a little bit on your plan, not only in terms of the rules of your plan and the quality of your plan, but let's say you are leaving either because you're retiring or you're moving to another job. You could leave the 401k where it is, right? Maybe you love the options that are in the plan. Like, for example, if you're in the federal TSP, you are not going to find some of the fund options in the TSP are as lowest cost as exists in the universe. So you might want to leave some of your money there, for example. You might have access to institutional shares that you would not have access to if you were just a retail investor trying to buy that same mutual fund. You'd have to pay a slightly higher expense ratio for that fund. Some accounts have particularly attractive cash-like options. So maybe money market funds or guaranteed investment contracts that you would not have access to if you were just buying it on your own. So that's one thing to think about, but you should check if fees apply. So for example, here at the Motley Fool covers the annual fees for all employees. If you leave the Fool, you can leave your money here with us, but you're then responsible for those fees. The other thing to do is to roll assets over to an IRA. And this is probably the most popular choice because the typical 401k, you're just limited to a menu of maybe 20, 25 mutual funds. You rolled over to the IRA and then the world opens up to you. You can buy individual stocks, ETFs, thousands of mutual funds. You have many more choices. And it does cost money to run a 401k. And depending on your employer, you are sharing some of the burden of those costs or maybe all of those costs. Whereas with an IRA, the costs are not so burdensome. You're probably not paying an account fee, for example, or anything like that. And then the other option is to roll assets into a new employer plan, right? If you're going to a new employer, they have a 401k, you could move that over as well. I'll just point out one other thing about all that. And then Buck, if you have any thoughts on it, let us know. You want to do, if at all possible, to do what's called a trustee to trustee transfer. So the money goes from one firm to the other. You don't touch the money. That's a lot easier than if someone sends you a check, because first of all, there's always this concern that the check's going to get lost. And if you don't get the money from one account to the other within a certain amount of time, it's considered a distribution and you'll be taxed and penalized. So if at all possible, have the money moved from one place to another. If you do get sent a check, and sometimes it's automatically sent to you, because if you leave a company and you don't have a certain number of assets, the plan's basically going to kick you out. You've got to get that check into an IRA or a new 401k as soon as possible. Buck, any thoughts?
I think you did a good job of covering it. I think we have some questions in the queue, but do we want to summarize anything else before we move over to questions?
Yeah, I'll just do that last part there.
Okay.
Once you retire, and you say you have multiple accounts, right? You have a brokerage account, regular taxable brokerage account. You have traditional accounts and Roth accounts. You're like, well, what should I tap first? There have been many studies that have looked at this, and they all agree on one thing, that you should tap your taxable account first. This, by the way, is after RMDs, right? Once you're over a certain age, you have to take required minimum distributions from your traditional account. You have to do that first. But after that, tap the taxable account first, drain that first, let your money grow tax advantaged in your other accounts, then the traditional, and then the Roth. Now, but those last two bullet points are a little more dependent on your situation, right? If you expect to be in a lower tax bracket in the future, then actually you should probably tap the Roth first. Or, for example, let's say you're recognizing a really big expense, right? Doing something to your house, taking the family on the vacation, and you have to take a lot of money out. You might want to do from the Roth, because if you take a big distribution from your traditional, that move you into a higher tax bracket, and that may then cause more of your Social Security to be taxed, or may cause you have to pay more money for Medicare, because your Medicare premiums are based on your income, subject to what's called IRMA, the income-related monthly adjustment amounts. So in that situation, it might make sense to tap your Roth a little sooner. So again, this is a situation where everyone's situation is different. This is not personalized advice. You should talk to maybe a tax professional or a financial planner to see the right order of withdrawals for you. But this is sort of the baseline suggestion that you'll read about.
Well, that's excellent. I want to add one more question for those. I know we have a lot of investors in our forum listening today. We have savers. Some of them might be parents. And so as we think about estate planning, and I know this is something you're right about, that's not what this section is about, but just as you think about bequeathing some money and you're going to have more than you need to live on in retirement, is there a certain account that you would be better off leaving to your heirs?
That's a really good question. And it's especially true if, I'll highlight it this way. The answer is yes. And in fact, it would depend on somewhat of the tax status of your heirs, right? So if you are at a point in your life and your kids are well into adulthood, right? If someone is very financially successful and already in a high tax bracket, you might want to save the Roth for them, because when they inherit that money, they have to drain it within 10 years and that'll come out tax-free. If on the other hand, you're in a high tax bracket, but your heirs are in a lower tax bracket, you might want to do the Roth and then leave traditional to them. And then the final thought about is if you have money in your taxable brokerage account that you have held for years and have a huge embedded capital gain, you might want to leave that alone for you, leave it to your heirs, because when they inherit it, they will get a stepped up cost basis, right? So let's say you paid $10,000 many years ago for a stock that is now worth $100,000. You die, leave it to your son or daughter. Their cost base is now $100,000. No one had to pay capital gains taxes on that $90,000. Plus, they could sell it the very next day, and any gains they had from the point they inherited it to, the point they sell it, it's going to be treated as a long-term capital gain, even if they only held it for a couple of days or a couple of months.
Yep, that's great. That's great advice. So I'm gonna summarize some of the things we talked about. We're gonna move the questions. I see they're rolling in, which is great. And I want to get to everybody's question. First thing is save till it hurts. The second thing is, especially when you're younger, The other thing I'd say is become an expert at your company's 401k. Go ask questions. You have HR professionals there and people to help you understand the plan. And if you have suggestions, don't be afraid to make those. Maybe you could step up and even join the 401k committee, and that would kind of force your hand to learn more about how all this stuff works. And I know that happened to us. We've learned a lot over 25 plus years. And then as we talk about in savings, at 15% is a good guide for people to start off early in life. If you can start off saving 15% of your income, you're going to put yourself in a pretty good position. And as far as investments, we talked about the target date fund as being one of those investments that's diversified. If you don't love doing this, you pick that target date fund or spread it across a couple of them, and that kind of diversifies you and it automatically rebalances things. And then we've talked about, of course, tapping into those funds later on. And start with your taxable accounts first. And we talked about a bunch of other stuff. So I think that summarizes some advice and information that we gave. Robert, do you want to add anything before I start asking our members?
Let's jump into the questions. I think
Let's do it. Okay. So if you were going to pick between two ETFs, this is from Duffer WD. Those are exchange traded funds. For those of you, they're kind of like mutual funds, but you can buy and sell them like stocks. That's what an ETF is. If you're going to pick between two ETFs for the equity portion of your retirement portfolio, would you pick QQQ? That's the NASDAQ 100. So those are mostly technology stocks, or SPY, which is the S&P 500. Bro, I'll turn that over to you. Would you go more on the technology front or more on the S&P 500 if you were just picking between two ETFs?
So, of course, this is based on your own personal situations. I think that S&P 500 is just the great default. I recently wrote an article about Warren Buffett's estate plan, and he talked in his 2013 letter that he's directed the trustees of the money that his wife will inherit to invest 10% in treasury bills, 90% in an S&P 500 index fund. I think it's just a great foundation. And then if you feel like you want more technology type of exposure, complement with the QQQ. But I often talk about when people ask, like, which fund should I buy? I would say start with what you already own, and then you buy something that complements what you already own.
Yeah, I think that's a great point. And I would say one thing that we did in the Motley Fool's 401k plan, although Robert just recommended this, we replaced the S&P 500 with the total stock market index. And so that's just a little bit more diversified than the S&P 500. We got a little pushback because we're big fans of indexing and Vanguard and all that stuff. And I said to those people, hey, just to let you know, Vanguard, the people that run this, did it in their own 401k plan. And I think they did it for a reason. You get access to some smaller caps and that kind of stuff. So I think maybe a little bit more diversified for going to the total stock market index. And the other thing I'd say, QQQ is probably a little bit, it's been higher valued. We know about the Mag 7, all those big technology stocks that have driven a lot of the performance in a lot of the indexes and ETFs as of late. And so I would say, to me, some of the fundamental dynamics of those technology companies have changed, where if you look at the capital expenditures they're making now, they're really high. So some people have even made, one CEO the other day on the conference call made the point that some of these companies used to be like large technology companies, used to be really cash generators and asset light models, but now they're investing so much in capital expenditure to keep up with the AI arms race that they look more like industrial companies to me, but yet they're valued very highly. And so I would say for that reason, I would probably be looking a little bit more like Bro said, but total stock market index instead of SPY.
I'm going to grab a couple of questions here that came in earlier. One from Kim. Hello. Since most 401k plans only allow you to invest in mutual funds, if a plan allows you to move your 401k funds to an IRA, what are your thoughts about doing that? We touched on this a good bit, so your question probably came in before we did, but I will just highlight a couple of things that I think it's a great idea. If you can move the money and your choices within your 401k are not great, or even you just want to diversify it a little bit, it makes sense to move it. And I will highlight one feature of most plans is that you can do what's called an in-service distribution. So you can move money while you're still working for the company. Now, for most in-service distributions, you can only do it once you've reached age 59 and a half, but it doesn't have to be that way. So I would check with your 401k and say, first of all, can I do in-service distributions? Second of all, what age? And third of all, can we move up the age if possible? They may or may not be amenable to that. But it is one thing to think about, especially if you are over 59 and a half and you're not completely happy with all your choices in the 401k. And then let me grab one from Vihan that came in 28 minutes ago. Can you convert 401k to Roth while still employed with the same employer? A lot of plans don't allow. You would have to leave firm to roll over or convert. So again, you could do it if you were allowed to do in-service distributions. So you could do the conversion upon moving the money. But it does, as you suggest, Vihan, it is dependent on your plan. So it's a feature, and there's no reason not to add the feature. As Buck said, a lot of these features don't cost any money. Depending on the feature, they might have to amend their plan, so they might have to pay, I don't know, it's like $150, something like that. Don't quote me on that. But depending on what features you add to the plan, it might cost the firm some money. So you might want to bundle it all, have a big company discussion about all the features you want to add, and then make the changes. But it's no skin off the company's back to allow you to do in-plan. It's often called in-plan transfer, but it's really a conversion.
Okay, so here's one that this is from Vihan, and this touches on a bunch of different subjects, and I'll try to get it right. But Vihan asks, can you open a Roth IRA for grandparents, if not there, with your grandson who's 5 years old as a beneficiary, and the parent actually contributes to that grandparent Roth using Roth vehicle for college? Now, there's a couple different parts that I want to pull about there. And I want to first start with the college part, because even though we weren't really talking about 401ks today, not college, but I do want to make a point. If you are a grandparent or you're a parent, you can contribute to a plan for your children's college education, and you could put a lot in there without any tax consequences as far as transfers. Bro, do you have anything to say about college funding, particularly for grandparents or parents? 529 plans is what I'm getting at here.
Yes. 529 are by far the most popular. There's no annual contribution limit. There are lifetime limits, but they're in the hundreds of thousands of dollars. They vary from state to state. If you contribute more than $19,000 from one person to another, there's some gifting issues, but you don't even really pay taxes. You just have to file an extra form. So highly, highly recommend the 529 as a savings vehicle for parents, grandparents, well-meaning aunts and uncles, friends. The benefit, of course, is that you put in the money. You might get a deduction on your state income tax return, depending on your state. But the withdrawals and the growth are tax-free as long as they're used for qualified education expenses. And it doesn't even have to be college.
Yeah. And I'd say we had 3 children. 2 of those are in college right now. And my parents used to, maybe people get this as well, they give you money, in the holidays or whatever. Here's the money. I don't know what to buy you. We just went to them and said, hey, we've established 529s for the kids. And if you want to give money, give that to them for their college education, which is a great way to do it. We don't get taxed on it. And that's a great gift that, that they will love down the road. And so that's a great option. The other one now you mentioned was, could you open a Roth IRA for somebody else and fund it with your money, Robert, and then give it to the child? That seems a little more complex.
Yeah. So first of all, to have a Roth IRA and to receive contributions, you have to have earned income. So this 5-year-old grandson must be earning money some way, and you'll come across little sort of end arounds for this. So, for example, you take a picture of your kid, you put the kid on your website, and you pay the kid a modeling fee. Like that is something that people actually do. But otherwise, it's pretty difficult for a 5-year-old to have earned income.
Yeah.
But if they do, then you can do it. And yes, the money does not have to come from them. A parent or a grandparent can contribute the money. But certainly once your kid is like a teenager and working jobs, getting some sort of a W-2, you can open up a Roth IRA for them and contribute the money. That's what we did for our kids. And it's very easy to do.
Us as well. So you mentioned that, they're working, they're getting a W-2 now. Maybe it's just a summer job or whatever else. Our thing was like, hey, we'll match that. We'll open up a Roth IRA and we'll fund it for you. You know what I mean? You got to go out there and earn it. And I think that's a great lesson, for children and things as general, is like, if they want something, encourage them to go for it, but have them get some skin in the game, right? Like, we'll match it. You want to buy the bike? Okay, we'll pay half. Go earn the other rest. Shovel snow, do whatever else you got to do, right? And so that's a good alternative for people.
Let me weigh in on using the Roth for college.
Okay.
And some people do recommend this because for 2 reasons. One, any money you contribute to a Roth IRA can come out tax and penalty free at any time. And it comes out first. Roth 401k is different. When you take a withdrawal from the Roth 401k, it's always a mix of contributions and earnings. Roth IRA, you can always take the money out first. So then you can use that for college. But then also withdrawals from IRAs, not 401ks, but from IRAs for qualified education expenses are exempt from the 10% early distribution penalty. Not exempt from taxes, but exempt from the 10% early distribution penalty that is normally assessed on withdrawals before you're 59 and a half. So there are people who think like, they rightfully say, I need to prioritize my retirement first before I save for college. So what I'm going to do is I'm going to contribute to Roth IRAs. Then once my kid is at the age of college, if I have at that point saved more than I need for retirement, I will tap my Roth IRA to pay for that. So it's a legitimate strategy for people who don't have enough cash flow to save for both retirement and college. And the final thing I'll say on this is my favorite resource about all this is savingforcollege.com. And they have articles about using Roth IRAs to save for college.
Great. We have Bill ask another question here. If I convert from a traditional IRA to a Roth in a given year, does that increase my adjusted gross income, affecting my Roth contribution eligibility?
Yes. And the answer is yes. So this is a very important point. So I appreciate you bringing it up. A conversion is not a free lunch. Anytime you convert money that is in your traditional account, you pay taxes. So if you're doing converting $50,000, you just added $50,000 to your taxable income. You're going to have to pay taxes on that, but then ideally the money grows tax free. But not only will you pay taxes, so it'll increase your tax bill, but because it increases your modified adjusted gross income, and that's what the MAGI stands for, it might make you ineligible for other things. So for example, you were eligible to contribute to a Roth IRA, but then you did the conversion and now you're no longer eligible to contribute to a Roth IRA. And there are many, for example, tax credits, education tax credits, for example, like the American Opportunity Credit or the Lifetime Learning Credit, other tax credits that are based on your modified adjusted gross income. If you are on the ACA paying healthcare, the premiums depend on your income. If you're in retirement, your Medicare depends on your income. So by doing a conversion, you might affect these other aspects of your finances. So it really does make sense that if you don't understand all that, to speak with a tax professional so you understand all the ramifications of doing the conversion.
Yeah. And I remember after our second child, my wife stopped working and we've rolled over her 401k into an IRA. Then we were very lucky because the government gave us kind of a one-time conversion incentive that they allowed you to pay the taxes for that conversion over, I think it was 4 years. That was a long time ago, but that was kind of nice because you could spread out those payments over that time period.
Yeah, and you can't do that anymore. And there's no limit in terms of your income and how much you can convert, but you can't reverse it. Several years ago, you were allowed to reverse it. Basically, you had essentially sort of like a year and a half, depending on when you did it, to reverse it. You can't anymore. So make sure that if you're going to do the conversion, it makes sense for you.
Yep. And so Julia asks, how is household income defined? Pre-tax, but excluding pre-tax 401k contributions. And I think so, Julia, yeah, I'll answer this. Yes, I think if you look at your W-2 that comes from your employer, you'll have like kind of a gross level and then a taxable level. And that should exclude the taxable level or for your income, any pre-tax 401k contributions you make. Am I correct there, bro? Or do you want to add
Yeah,
something?
I would say it depends, Julie, on what you're asking about. So if you were asking, for example, about the T. Rowe Price illustration that we showed, that you should have a certain multiple of your household income saved by a certain age, I think that would be just complete gross income, not factoring in 401k contributions or taxes. So if you have more color you want to add to what specifically you're asking about in reference to it, but I think otherwise what Buck said makes sense.
Yep. Happy Fool says match from employer. And if they have stock buy-in, set it and forget it. Stock's at a discount anyway. Usually employers, if they have employee purchase discounts for stock, they usually give you a break on those. And so that's a good deal. And he says, build a bigger emergency fund than you think you need. And bro, that's something we didn't talk about today. And I do want to mention that. I would say start with, we generally tell folks 6 to 9 months of living expenses is a pretty good place to start for an emergency fund. And Happy Fool says, you might want to consider more than you think you need. Do you have any other things to add in besides that 6 to 9 months of living expenses to have as emergency fund?
I think that's a good starting point, especially for people who are watching this, right? If it were my son, for example, who has no financial responsibilities whatsoever other than renting his apartment in Salt Lake City, you probably get away with less. I would want him to get more money in his 401k. And I do think it's important to determine which expenses they are. And I think in terms of essential expenses, and what is essential for everyone varies from person to person. But I always think it's good to look at your budget, which is good because, first of all, you're going to find something that you're spending money on. And you're like, that's a waste of my money. I should stop spending money on that. But also understand, like, what's the bare minimum you need every month to pay your bills, right? Right now, we're hearing about a lot of layoffs, a lot of people in the federal government, a lot of, frankly, the friends and neighbors of people like me and Buck who live in Northern Virginia, close to Washington, D.C. And for people like that, I think it's very important, to figure out exactly how much you need every month and have at least 6 to 9 months of that set aside.
Yep. And John snuck in a stock question here. He knew this was about 401ks. He asked about Winmark and MedPace. I see you, John. Yes, they're getting cheaper. If I had to pick between the two, and I own both of them, MedPace is a little bit cheaper here, and they're known to really buy back stock, and they just started doing that. Winmark is still trading a little bit expensive, even though it's sold off. So you got your one stock question in there, and we'll go back to 401ks now.
I want to grab one from Bhavesh. I hope I got that right. Yep. It's important because we only have 6 minutes left, and I want to make sure we get this. So the question is it rolling tax deferred 401k to Roth, 401k, mega Roth, conversion incurred tax liability? So yes, if you have money in a traditional account and then you convert it to the Roth, that will be a tax liability. Now, we talked about, when you talk about the mega Roth or the mega backdoor Roth, that is a situation where you're contributing after tax money, if your plan allows it, and immediately converting to the Roth. Now, if you have already been contributing after tax money, so you already have money in this account that has after tax and some growth on that, and then you do the conversion, then you're going to pay taxes. So the mega backdoor Roth makes the most sense if you start fresh doing after tax contributions and you immediately do the conversions if your plan allows it. Because otherwise, every time you start doing conversions, even of the after-tax money, if you've already built in a year or 2 or 3 or 4 of gains, once you do the conversions, you're going to have to pay taxes due to what's known as the pro rata rules.
Yep. Great. And Vivesh also asked, can you transfer some funds from your 401k to a charity without incurring taxes?
And the answer is no, but eventually. And what I mean by that is, I think the question is about what is known as qualified charitable distributions. They can only come from traditional IRAs, but of course, once you're able to, you can roll money over from the 401k to the IRA. You can do qualified charitable distributions once you are 70 and a half. The benefit of that is that you are moving money from the traditional IRA straight to the charity. And that way the distribution, you avoid paying taxes on the distribution. So if you are charitably inclined and over that age, there's really no reason not to do it that way, especially once you're at the age of RMDs and you don't need the money. Just know that you have to follow the rules. Like, you can't take the money from your IRA into your checking account and then write the charity a check. The money has to go directly from the IRA, traditional IRA, to the charity. Contact the charity. They will tell you how to follow the rules and how to facilitate that transition or transaction.
Great. Now, here's a question from Timothy. He said it's about annuities, Robert, and that's a retirement topic that we didn't talk much. He said typically do they earn lower than 401ks due to their additional costs? Would you invest in an annuity versus a 401k as far as having a mix of investment vehicles? And I'm going to let you answer this, Robert. I have my own opinions on annuities, which we've talked about for a long time. And I would say, Timothy, you're on to something here, because when we build, and I head up our investment committee on our 401k, when we pick investment choices within there, The biggest determiner of future success is fees, right? The less you pay in fees, the better opportunity or better chance that that investment vehicle will perform. And annuities can come with some pretty hefty fees attached to them. But bro, I'll let you answer it. Should you invest in an annuity versus a 401k? What's the difference?
So there are all kinds of different types of annuities, but to do the apples to apples comparison, what you're talking about is a variable annuity. So it's very similar to a 401k in that you put money in and then you choose from different, they're essentially mutual funds, although they're called sub-accounts, but they operate the same thing. In fact, they're often identical to a mutual fund that you could get elsewhere. But as Buck pointed out, they almost always have higher fees. Now, they will come with some guarantees as well, and the guarantees vary from annuity to annuity. And there's sort of like a base guarantee. So, for example, it might be like you put in $100,000 and we guarantee that no matter what happens, you will always have at least $100,000. Or it might be that we guarantee that your account will grow 3% every year. It just varies from the annuity, but those guarantees aren't free.
Yeah.
So the baseline suggestion, without knowing your situation or the annuity you're looking at, is that you're generally going to be better off choosing a 401k instead. You get a deduction on the contributions if you're doing traditional, which you don't get with an annuity. And you manage the risk by just choosing the right asset allocation for you rather than paying an insurance company for that.
Okay. Here's a question by AD. Are there any types of funds you should stay away from in 401ks because they don't make as much sense in that type of account? I'm going to expand that just to stocks as well, because we know in our account, we can trade individual stocks and things like that and own. I shouldn't say trade, invest in. We don't trade at the Motley Fool. We invest. Are there any types of investments that you wouldn't want to own, Robert, in a 401k?
That's an interesting question. So let me just highlight first, for example, that
some plans allow baseball cards and collectibles and art and all kinds of things. So there's a wide discretion of things that you can own within a 401k.
Yeah. So I'll highlight a feature we have at the Motley Fool, that we do have a brokerage account and we can buy anything we want. And if you don't have that at your 401k, ask your provider to see if you can arrange that. Given that we at the Motley Fool basically believe, like, if you've done your analysis and you believe something is a good investment, I would say it makes sense to own it. The first thing really that comes to mind is municipal bonds, because the reason you invest in municipal bonds is that they have tax breaks if they're held outside of a retirement account. It doesn't make sense to hold municipal bonds within a retirement account. There are some restrictions on some 401ks, like no Bitcoin or something like that. But I'm not going to give my opinion on Bitcoin. I don't know, but is there something that comes to mind for you here in our last maybe 15, 30 seconds?
Yeah, I would just say things that come with high fees attached to them. When we first made our 401k committee at the Motley Fool, we had an S&P 500 index fund. We love indexing, bro and I. The main reason we love it, though, is because it's inexpensive. You can buy a Vanguard index fund for 3 or 4 basis points. When we had it back in the late 1990s, we were paying 1.5% a year in our 401k plan for a perfectly good investment vehicle, an S&P 500 index fund, but the fees were way too high. So what I would just say is, if you look across your funds and the investment choices that you have, I would sort them by the fees that you pay. And I would say, if there's actively managed funds that have, fees that are over 1% or something like that, I would give them extra attention to say, maybe I should gear more towards an index or a lower fee option. It might be, a cheaper cost, because fees really do matter and they compound year after year when you don't pay them.
So that is it for our show on making the most of your 401k. We hope that you enjoyed a thing or two. Any questions that are still in Slido, if they're still around next week during the retirement show or financial planning power hour that I do with Dan Kaplinger at Tuesday and Wednesday at 10 a.m. Eastern time, I'll be happy to answer those. But in the meantime, thank you for tuning in, and we are going to turn it over to Toby and Rachel. Fool on, everybody.
You guys, fool on.
Thanks, Buck and bro. We are heading into our next hour now, Rachel and I, and we're talking about recent and upcoming IPOs. We thought that'd be fun to take a look at today. We have a few that we're ready to address just kind of quickly here, but we also want to get your questions on this. If you have any companies that have recently gone public that you want us to look into specifically, we are happy to do that. And what are we going to define as recent? I don't know, Rachel.
The last couple years, 12 months.
Whatever. Yeah. So however you guys want to do that, we'll newly public companies, right? That's kind of how we're thinking about it. Plus things that may be on the horizon in the next couple of months. There are a few of those, including I think one that you've got in mind that you want to.
Yeah, I have one or two that I have been kind of watching. You know, when we talk about upcoming IPOs, this sometimes also means companies that they haven't formally announced. There's been a lot of speculation, but it's also interesting to talk about those types of businesses, you know, before and if they become publicly traded.
Yeah. All right, cool. Well, let's hit it. Let's get into it. What do you want to hit first? Do you want to talk about one of those upcoming ones, or
I think why don't maybe you talk about a more recent one. I mean, Reddit, it seems hard to overlook Reddit, you know. So Reddit's IPO, I think, was broadly considered a pretty, you know, significant success when that occurred last spring. You know, the stock price nearly doubled on its first day of trading, closing around $50 a share. That was a 48% increase from Reddit's IPO price of about $34 a share. That valued the company at the time at around $6.4 billion. Looking up at the company's, you know, current valuation, you know, it has fallen a bit since that time. Its current valuation is about $27.8 billion. Although looking back over the last 6 months, shares are up by about 178%, which is a pretty notable hike in a short period of time. But I think there was a lot of interest for a very long time around this company, which has, you know, been known as one of the most surfed platforms on the web today. And this has been an interesting one, you know, for me to watch. I am a user, obviously, of Reddit. I have been for a long time. I'm not currently an investor. And for me, some of the biggest things I've been, you know, watching with this company is what does their monetization strategy really look like, you know, moving forward? Right now, advertising is the primary source of revenue for Reddit. So that's their main source of income. Advertisers pay to display ads on the Reddit platform across a whole host of different formats that can include promoted posts as well as videos. Then they make a much smaller portion of their revenue right now through premium memberships, right? So you can subscribe to a premium membership to remove ads and access exclusive features. But this is something that is still, you know, arguably a very, very small part of the business. You know, it's interesting when I was looking through their shareholder letter for 2024 that came out recently. You know, there were some really interesting highlights there, especially when it comes to their machine learning models and machine translation and the way they apply that to the platform. You know, obviously, this is a global platform, right? There are millions and millions of users who speak all sorts of different languages all over the world. And it's interesting because they were saying, you know, we made meaningful progress improving our machine learning models to make the home feed and search results more relevant and translating content for global audiences with machine translation. They said machine translation drove between 40 to 50% of international user growth in Q4, and our international playbook is driving community engagement in our focus countries. Their machine translation tool is only actually launched in a very specific number of markets. As of the time of their full year report, they had launched their machine translation tool in 8 languages: French, Spanish, Italian, Portuguese, German, Swedish, Dutch, and Filipino. And they are on track to expand to additional languages and target markets in 2025. But it remains that Reddit is, you know, one of the most visited sites in the US. It is one of the top sources of human generated content on the global internet. And what's also interesting is that you've got, you know, 20 years of conversations at this point that you can go back and find on the Reddit platform. And as of just December 2024 alone, an average of 40 million daily search queries were run on the platform. They're also, you know, not surprisingly leveraging AI tools to, you know, make their platform better. So it's an interesting business. You know, this is one where I've kind of made a rule for myself in my investing journey that I try not to invest in too newly public businesses. I like to wait a couple years, see a couple years of solid financial reports as publicly traded companies, you know, before I put money to work. And obviously sometimes that means I, you know, miss out on some real stock run up momentum. But that's been the case with the stock. I've held off from taking a position also as they're working to get to, you know, more habitual profitability. automation and AI is really key as well for their ad tech investments that they're making as they're trying to grow their revenue sources. So that's something else I'm watching. It's an interesting business. Curious to hear your thoughts, Toby.
Yeah, I want to show a screen share quickly here. We'll get that to come up in a second. This is just a chart from the IPO versus the S&P 500. Reddit in purple, S&P total return in orange there on a percentage basis. And this is interesting to me, Rachel, right? Because a couple thoughts on this, right? I too like to give companies at least a year when they come public before I'm super serious about it and invested as a public company. There are exceptions to that. Reddit probably is an exception because it's been around for a while, right? For quite a while. Like there is a lot of history with this company, both the business and the brand, right? So this is one I would be less concerned with going into. Now we're coming up on that year mark right now, right? As we get into April. But the other thing that's interesting to me about this chart we're seeing here, and the price movement for Reddit after IPO, is this was a well-known company, very well-known company, especially among the internet scene. You think about individual investors who invest, online investors know this company well. There are many investment communities on Reddit, right? Both now and prior to the IPO, right? So this was not an unknown quantity to a large pool of potential investors here. And yet, what do we see? We see it very early on. Now, it did double, right? So it did close double the IPO price, which is not too bad, and maybe that's a good thing if you're an underwriter there. And you see that substantial tick up on a percentage basis here, right?
Yeah.
Early on, but then it kind of went along slowly.
Yeah, kind of a quiet few months after.
Not a lot happening for like a good 6 months or so. For this company, even though everyone knew what it was, the IPO was highly touted. It was not a surprise when this thing came public. And it wasn't until the end of last year that you really started to see this big run up as they started producing some financial reports that made people take notice. Now, I want to also note what's happening at the end of 2024. Chat GPT, large language models, the AI craze. And this was a boom for a great, both a boon and a boom for Reddit. Why? Because they can license their data to train AI models, right? That history you've been talking about, that 20 years of conversations, the LLM model trainers want that, right? And so they go to Reddit and say, hey, we'll give you a boatload of cash if you let us train our AI model on your data here. And this is why we've seen a surge in stock price, which is corresponding to a revenue jump, that source of revenue, right? The AI training model. So not only are they using AI in their platform, it's a source of revenue for them, like a big source of revenue to train these models. Now you might ask yourself, does that continue indefinitely? Maybe not, and maybe not at the price we're seeing. So it's, you want to see some diversity of revenue streams as they continue to grow and expand here. But the AI boom really came at a good time for them, right as they, a couple of quarters as they came public, to supplement what was just advertising revenue, right? For the most part. That allowed them to say, to show investors, look, here you go, right? Making money. And that's been quite nice for this business. So when you look at this chart, and you look at the growth in the stock since IPO, it does not look to me like it's a IPO hype craze driven increase.
Oh yeah.
That's not
no,
what
I don't think so.
We saw none of that for the first 6 months, right? The recent run-up has come from a business situation, a very real new source of revenue that was unanticipated, that they were able to take advantage of, that they're really well positioned to take advantage of. How long will that last? I don't know. That's a risk you want to consider if you're looking at this company. But you certainly look at the run-up we've seen, I think, as a legitimate response to a changing business situation that they found themselves in the midst of. So I like that a lot, right? It's a very, very interesting business. I think people need to consider with a caveat that, be cautious in the face of this of the AI revenue they're generating now, because we're not quite sure how long that persists and in what form. But hey, take it while you can get it, right?
Yeah, it's kind of interesting because, we think about the level of data that's on that platform, right? So daily active unique users on Reddit increased 39% year over year to about 102 million at the end of last year. And how they define a daily active unique user is someone with a unique identifier who's visited a page on Reddit or opened a Reddit app at least once during a 24-hour period. There are millions of these users that have their data on the platform that can provide this really essential source of information to train these models, as you noted. And, there were reports a little over a year ago that Reddit had struck a deal with Alphabet, allowing them to access and use a large amount of Reddit user-generated content to train their AI models in exchange for a reported payment of about $60 million a year. Again, there's some, unknown elements here, but this is what the reporting was at the time. And there's, the idea was that Alphabet would use Reddit posts and comments to train their AI models, which could improve the accuracy of their search results and other AI powered features. That's an interesting dynamic to me, because on the one hand, you could see how this can be extremely mutually beneficial for both of these businesses, right? Alphabet with their, 75 billion in expected CapEx on AI this year. And then obviously Reddit has its own role to play there. But you could also see a situation where there is a dynamic where this kind of dynamic becomes less beneficial. Does Reddit start to see a bit of a threat from some of the large language models that it has helped to train? You wonder. I don't think these models would replace the type of use cases that Reddit presents to its users. But it is interesting to think about how that dynamic could shift through the years, and what other companies, if not already, might be wanting to strike deals with Reddit to do the same.
Yeah. And that the AI stuff started early, right? Actually pre-IPO.
Last February that story came out. They went public, I think, in March, I believe.
Right. Yeah. And so that's something that was kind of flying under the radar until everyone started paying attention. And also they just started making more from it as they got more deals in the fall of last year, right? Steve Mitchell was down 15% on Reddit, but holding 30 billion market cap, room to run, very sticky. You saw that kind of pull down recently that we've had in the last couple of months, which I think is less Reddit related and more general market related. We've seen several companies, several tech companies, a lot of them seem to decrease over the past month or two. I think if you're in there, it's you hold through the temporary, or hopefully temporary downturn. We never know for sure. But it's a compelling company, and it's an interesting one to consider. A lot of growth ahead potentially for what they're doing.
Yeah. Well, another company that's kind of interesting as we're talking about more recent IPOs, I think before segueing into maybe ones that could be but have not yet materialized, is Instacart's an interesting one. That's a company I've followed a bit. They went public a little longer ago. They went public in 2023, September 2023. Their initial share price was about $30, and that stock price rose to about $42.95 in the first few minutes of trading. And then the stock finished its first trading day up about 12%. And that IPO valued Instacart at about, $10 billion. Now, where the stock is currently, that their market cap is just under $10 billion. In terms of share price, they're trading up about 30% since IPO. So definitely not the run up, we've seen from a business like Reddit, which obviously has a completely different revenue model. But these were probably two of the most notable IPOs that, have happened in the last couple of years. I mean, we know back several years ago, there were so many companies that were entering the public markets, and there's been a lot of smaller businesses that have done so, but it has not been the type of rush to bring companies public that we had seen previously. And so, it's interesting. Instacart is also another one I watch. I'm a user of, but I'm not a holder of, and I probably of the two am more bullish on holding a company like Reddit for myself over the long term. But Instacart, they don't just work with grocery stores; they work with restaurants, other companies that are listed on the platform. They primarily make money by charging customers a service fee on each grocery delivery order, and that includes a markup on items that are purchased from their partner grocery stores. They also make money from membership fees from their Instacart Plus subscription service, then that offers unlimited free deliveries if you place orders above a certain amount. So they earn revenue from both the customer as well as the grocery stores that they partner with and other merchants like restaurants, for example, by facilitating delivery services. They even have a smaller portion of their revenue that comes from advertising. So advertising deals that they do with some of the grocers that are listed on their platform. So delivery fees is still their main source of income. And again, that really varies based on order size, delivery time, whether or not the customer has a Instacart membership. And then they also earn a commission from grocery stores on each sale that's made through their platform. So they have a pretty diverse, revenue base there. They had reported their earnings at the end of February. They had a nice double-digit increase in both total revenue and gross transaction volume, although revenue was slightly below what analysts had been predicting, and I think that was reflected in some of the response that share prices reflected. But it's kind of a fascinating business. They had, as of the end of 2024, about 1,800 retail banners. They reach currently 98% of households in North America, helping customers shop at retailers, restaurants, grocery stores. So there's kind of a wide selection of brands there. They say that we provide discovery and attractive return on investment for over 7,000 active brands through our advertising tools and insights. And our ads deliver more than a 15% incremental sales lift to those partners. So again, advertising revenue for its brand partners is a notable and increasing part of revenue. And as of the end of 2024, they offered 600,000 shoppers an immediate flexible earnings opportunity that allows them to choose when and how much they work. So they have something like 600,000 gig workers that are delivering, for Instacart. They are, I'm not sure if, I don't believe they are currently profitable. I'd have to pull up that number. I know that they have been, growing revenue really steadily. Actually, they are profitable. I surprised myself. Looking at 2024, they reported net income under GAAP of about $457 million. That was on total revenue of about $3.4 billion, which was up 11% year over year. So kind of to give you a breakdown of that, their total revenue last year, $3.4 billion. Transaction revenue accounted for about $2.4 billion of that total. Advertising and other revenue was a little bit less than $1 billion. So still a smaller part of that business, but it's worth noting that advertising revenue grew about 10% compared to 2023. So, obviously this is not a company without its competitors, right? You can think of the DoorDashes and Uber with their Uber Eats division. And also, if they want to expand internationally, there's tons of international companies with delivery apps, but they are making strides to differentiate themselves. Something that they have been rolling out that I have found really interesting and that I didn't really know much about is something called caper carts, which is like a new type of shopping cart that can recognize and weigh items. It's like a futuristic looking shopping cart that has a screen on it with all this information to help you shop, and it aligns with the Instacart app. And so I believe it's merchants that have these carts that's an option for shoppers as well. So kind of interesting to see how they're leaning into different technologies for their platform.
Yeah. It's the DoorDash is probably the biggest competitor you think of, right?
Yeah.
Instacart. And Instacart traditionally has been more on grocery delivery and other kind of pickups, whereas DoorDash was focused more on meal delivery from restaurants. Now DoorDash is now doing grocery delivery and other stuff, other retail delivery as well. So you've seen some. They're starting to bleed over into each other's prior core businesses here. And I think the difference too, right, is traditionally DoorDash had just gone to pick stuff up and bring it to you, where Instacart shoppers would actually go and do the shopping for you, right? I don't know how DoorDash actually does its grocery business, if they do the shopping or if it's more of a pick up what the store has put together and take it. I haven't ordered DoorDash from, well, anything from grocery stores really, but I know Instacart had those personal shopper idea that would go in there and do stuff for you. Like they kind of control the whole experience for them. So slightly different models for them there, but you're starting to see these companies bleed into each other. And you got Uber out there too, Uber Eats, which does restaurants, does groceries, does other things. Like Uber Delivery does pretty much anything now, right? I think you can, for the most part, do that. But those are your three main ones, right? In the US, Instacart, DoorDash, and Uber. It's Lyft even. I don't know if Lyft even plays in that market as much.
I don't think so. I don't think, at least not yet.
Yeah. So there is some competition for sure. And you ask yourself, how many do you need? How many can you support in the market? One or two probably. Two probably, I would think. Maybe three. It's more of a branding thing, I think, and what consumers become comfortable with, who they perceive as offering the better service, the better pricing out there. From the contractor standpoint, right, from the person actually doing it, they kind of go back and forth or work for all of these. You see people doing everything, right? You see people doing both Instacart and DoorDash and even Uber for kind of depending on what gives them the best deal. So there's competition in both ways, right? From these companies and everyone working with them. But yeah, this is a good one too. As maybe this market continues to grow and expand, and I think, Rachel, if we do move into a recession or tougher times here, when consumers get more concerned about pricing, you're going to see, I think, kind of how these businesses stack up in that environment and whether they can continue to grow in the face of maybe consumer resistance or rethinking services like this, which may not be strictly necessary, and it was kind of provided convenience and how much people are willing to pay for that. So that'll be interesting to watch over the next couple of years here as well. All right, what do we got? I'm looking at the questions here too. Other companies. So let's talk about a few more while we'll get some questions in here. Viking, also an interesting one that recently went public last year. Viking Cruise Lines, not therapeutics. Viking Cruise Lines. This one I put more in the Reddit category as a company that's been around for a while and has recently gone public. Viking, let me see when they were. Let me look up here when it was founded here. But Viking, so 1997 is when Viking was founded, which is it seems not too long ago, Rachel, but it's actually almost 30 years ago. That date, right? Yeah. So yeah, they've been around for quite a while, but they only went public last year, right? So, and they expanded rapidly or steadily along the way there. River cruises, adding ocean cruises, some more expedition cruises as well. They've got about 100 ships now in their stable. So they had a lot going on before they actually went public. A lot of brand recognition, a lot of business, a lot of revenue, a lot of assets. It's not some recently new company that went public to get money, right? I mean, to grow. Like the IPO, and they're still, I believe, majority owned and controlled by the founder and his family. The IPO, I think, had some elements of estate planning transition in it. Like, well, what are we going to do when the founder moves on to the great beyond, as it were? Is this going to be maintain a private business? Do we want to do something more with this? And I think they were looking to expand, right? To grow. The ocean business is relatively recent. The entry into the U.S. market is relatively recent. So the IPO helps get some capital with that. Once you become public, you can do secondary offerings if you need to. It's easier to raise debt potentially, because you can do convertible debt, right? That sort of stuff. Get capital, but both expansion, but also kind of get them point where they're looking for the next phase. They're looking for the next stage of the company's growth cycle. But different from the situation where you say we have to do the IPO to get money. Like, they didn't have to do it, right? This company would have continued on quite well, I think, without the IPO. And in some ways, you like businesses like that, mature businesses that are profitable, that are making money, and that can perhaps continue to grow to the next level as a public company. But a different type of cruise line than the big mass market ones, I think many people may be familiar with, like your Princess, Celebrity, Caribbean, NCL, even Disney, whose ships are smaller than some of the bigger ones, but you consider them a mass market cruise line, right? They're more family oriented. Viking's a more, I would say, hits the luxury end a little bit more. The ships are smaller, especially the river ships. That's by their nature. But even their ocean-going ships are a little bit smaller than what you'd see on the bigger lines. They do not target families. This is not a family-friendly cruise line. I don't think they even allow kids under 18 at all on their ships. So you don't have to have some of the things that you would associate with a family-friendly line, right? We don't need kids clubs. Right, you don't have rock walls on Viking ships. You don't have roller coasters and all that stuff.
This is true,
right? You have more sedate. You don't have dance parties, at least that I'm aware of. Right, more sedate bars, restaurants on the ship. Smaller group of people, smaller group of passengers. They have a theater where they can do lectures and whatnot. More education oriented in a lot of ways there. They just target an older audience. Even though it's 18 plus, you're not going to find a lot of 20 and 30, even 40-year-olds in a lot of ways on these ships, right? It's going to be a retired crowd, an older crowd, a wealthier crowd, which is good, right? From the business standpoint, a crowd that might be a little less susceptible to economic up and downs, because many of them are no longer working, right? They're living off of retirement income, investments and whatnot, what have you, and have a little bit of a steadier income there, and have the capital and resources to just go literally travel the world on some of these ships here. So different sort of business, different sort of cruise line. One I like more and more the more I look into it. So this is I think one to keep in mind.
Yeah, I think they report their full year earnings soon. I don't think they have yet, but
Yeah,
it's an interesting company, interesting one. You know, speaking of like rumored or unexpected IPOs, there was actually news out today from Bloomberg that Klarna is planning allegedly to file for a 1 billion plus IPO as soon as next week. So this is reporting from Bloomberg. We'll see, how this comes to fruition, but obviously this is usually a very strong and reliable source. So according to Bloomberg, Klarna is seeking to raise at least $1 billion in a US-based initial public offering. They're set to file publicly as soon as next week, according to people familiar with the matter. The payments business, according to Bloomberg, aims to price their IPO in early April. And again, the people asked not to be identified. The information isn't public. They also said that Klarna is targeting a valuation of more than $15 billion on the New York Stock Exchange. They had confidentially filed for an IPO with the SEC, according to a statement in November. And there's been reports that they've been working on the listing with a bunch of banks, including Goldman Sachs, JP Morgan. This is an interesting one. We've got already publicly traded buy now, pay later companies like Affirm is obviously a really notable one. There are obviously others. They kind of operate on that classic buy now, pay later model where customers can split purchases into multiple payments. You can pay in 4 if you check out at your chosen merchant with Klarna, which is 4 interest-free payments. You can pay in 30, which is paying for your purchase in full within 30 days without interest or fees if paid on time. And then they also offer longer term loans with interest assessed depending on what the duration is, as well as other factors related to that loan. So it's interesting. They make most of their money through merchant fees as well as interest on customer payments and late fees. So based on the information we have about the company so far, that as a non-publicly traded entity, they do, I believe, make money from merchants by charging them a commission on each transaction that they process through their platform. And that transaction commission can range, up to 6% or so, depending on the country. And so merchant fees are actually a really significant, if not the most significant portion of revenue for Klarna, rather than just revenue tied to lending directly, right? And obviously they make money from interest on, money that customers pay over time. For larger purchases, Klarna can charge up to a 19.99% APR over a 36-month period. And then obviously their interest rate varies from customer to customer, depending on credit score and other factors. And then there's a portion of revenue they make from things like late payment fees, to users who miss or delay payments. They even have something called a one-time card that I think allows customers to divide their purchase into 4 installments using a card. So kind of interesting. It's like, again, we look at the buy now, pay later model. That's something that one could assess could be quite risky depending on how the macro environment shifts. I think it's interesting how they make so much of their money, as far as we know now, still from merchant fees. Obviously, if they are going to formally file for an IPO, we'll get to see their S1 and other filings soon and get a much more in-depth look into the company and what that looks like. But kind of interesting. So yeah, that was just fresh out today.
Yeah. And they did file November,
right?
That confidential thing, right? I saw something they were talking April, but it looks like maybe they're moving that timing up based on the news that's out today, right? Potentially for that.
Could be April. Yeah.
Yeah, we'll see how that comes. I feel like the news that's leaking now or coming out, it's probably going to happen, right? And it's very interesting. They actually that November filing I saw from the Wall Street Journal was actually after the election, right? So if you're thinking, do the recent macro events put a damper on that? I would suspect not, right? Because I think they deliberately chose, this is a Swedish company that decided, look, we want to file in the U.S. Because this is where they're targeting their expansion, right? They wanted to list on U.S. exchanges, both for investors and just kind of be here to some degree as they expand more in the U.S. What's the biggest player in the U.S. right now? Is that Affirm in the buy now, pay later?
I think Affirm is one of them.
Yeah.
I'd have to look.
It's a big market, right? It's a growing market, and again, like
we've got Sezzle. That's another one, right?
Yeah,
they operate in the U.S.
The DoorDash, Instacart situation, where I'm curious to see how that whole industry goes through a recession, how it survives, or how it survives or thrives in a recessionary period. Same with buy now, pay later, right? I think this is one where you really would want to see how the businesses do in a recession or downturn that is driven by a pullback in consumer spending. Does revenue drop? Do they get used less? Do they have more defaults? Do people turn to them to kind of keep the spending at a higher level as incomes might drop or prices might increase here? We'll want to see how that goes, right? How do they navigate an entire economic cycle like that? And coming public, right, when we might get headed into one, is a very interesting thing to do. I mean, you can't time these things, right? Like, it is what it is, right? And even people doing IPOs aren't necessarily able to ideally pick their times. Like, we all can't be Reddit, right, where we come public right as a brand new revenue source is about to explode for us. This is one that we will watch carefully when the formal S1 gets out there. Have an announced IPO, if they actually do formally announce that in the next couple of weeks here. So that's a fun one.
Yeah. Another one that I've been following a bit, obviously as a healthcare investor, there's a medical supply company called Medline Industries. they actually filed not too long ago, I think in December, a confidential draft registration statement with the SEC. The plan from all reporting that I've seen is that they intend to go public in 2025. Reuters reported that were setting the stage for a blockbuster US IPO with their confidential filing. For anyone that doesn't know, Medline Industries, they're one of the biggest manufacturers and distributors of medical supplies in the country. They are an international company as well, but they manufacture and distribute a wide range of medical products. So gloves, gowns, textiles, durable medical equipment, surgical trays. They have a lot of different markets that they serve, including hospitals, nursing homes, home health. They have their own, integrated, supply chain solutions. They currently operate in more than 120 countries. They have thousands of employees worldwide. They're headquartered in Illinois. And what's actually interesting about Medline is they went public back in the 70s, and then they were privatized by the Mills family. And so now they're looking at, many, many decades later, another IPO. They're a massive, massive entity. There's been reporting that the IPO could value the company as much as $50 billion. And it would be the first, ortho-like company to really test the IPO waters in 2025. So, we'll see, right? There's a lot of trepidation in the markets right now. Could that shift what some of these companies are planning to do? Perhaps, but this is an interesting one I'm following as well, Medline Industries. So kind of a completely different industry and shift from the likes of buy now, pay later.
Right. Yeah. All right, let's take a look at our questions here. We do have a lot, so in the queue, let's see if we can answer some, even if we have to shift away a little bit here. I think there's a lot.
Oh, yeah. Let's see. Here, so, Foot Locker, there was a question about a day ago from Ted Has Options. We can probably both weigh in on this. Foot Locker reported with a positive market response, contrast with Nike. Are they frenemies? Actually, I haven't had a chance to see how is the stock doing? Okay, so it's down about 2% today, up about 3% over the last 5 days. And I think what was interesting also to note about this, Foot Locker and Nike have collaborated on a variety of initiatives through the years, including, store partnerships as well as longer term brand partnerships. And their largest brand partner, Foot Locker's, is currently Nike. And one of the issues Foot Locker's been dealing with is that Nike is using discounts to clear out older and, more stale, if you will, inventory. And so that's actually impacting Foot Locker's performance. So even though they delivered, mixed results for the holiday quarter, what's interesting is that they actually beat earnings per share by about 20% from what analysts have been targeting, even though they missed on revenue. And I think the fact that there was that beat on the bottom line, despite the fact that some of the numbers, which I'll get into here in a second, were not, super positive. I think that fact was where you saw, the stock movement heading in a more positive direction, at least, immediately after they reported earnings. So the stock currently trades about $18 a share. Looking at the actual results, this was their Q4. They also issued their, 2025 financial outlook. So total sales last year down 5.8% year over year, but comparable sales were up 2.6%. Their global Foot Locker and Kids Foot Locker comparable sales were up 3.6%. Gross margin expansion of 300 basis points year over year. They also refreshed about 160 different stores just in the final quarter of the year, which brought their total store refreshes to over 400 for the year. When they finished out 2024, they had cash and cash equivalents of about $401 million compared to total debt of about $446 million. They are targeting their sales for 2025 to be anywhere from -1% to 0.5% growth, but they're targeting up to 2.5% year-over-year growth in comparable sales. So that's something to note. This was a fascinating one for me in terms of how the market responded. Right? I mean, looking at total revenue, it was mostly flat in the 12-month period compared to a year ago. So in 2023, they reported total revenue of about 8.2 billion. In 2024, they reported revenue of about 8 billion. So down slightly year over year. The major improvement was on the bottom line. So in 2023, they reported a net loss of about 330 million. And then they reported net income of 12 million in 2024. So that was a positive shift. And again, notably above what analysts had been projecting. And I think that was why we saw that kind of response to the stock. They're still dealing with these, inventory issues, and obviously their guidance as well for fiscal 2025 profits. They're expecting to be lower than what Wall Street had estimated. And they're dealing with this kind of shifting in growth that is really coinciding with what's happening at Nike, which is again its largest brand partner. Which there's been this turnaround under new CEO. They're relying on a lot of discounts to clear out inventory, and the thing is, when Nike is in a promotional phase, it impacts Foot Locker's business a lot because that brand represents about 60% of Foot Locker's overall sales. So deep discounting and strategies to return Nike to growth very much impact what's happening at Foot Locker. And I think that's what you're seeing right now. But like I said, very much an improvement in their bottom line. Foot Locker is also really working on remodeling their fleet of stores. Like I mentioned, when going through those results, their stores are still responsible for more than 80% of overall sales. They're dealing with some weaknesses in the Asia Pacific region. And they have, as of late last year, they had announced that they were closing some stores and e-commerce operations in a few key markets in Europe as well as in Asia, and going to be relying on some third-party partnerships in some of these regions. So they've really been going through a shift in this period, and some of their performance, I think, is down to them needing to refine and upgrade their operations, which they're, I think, trying to do to meet the demands of customers now. And some of it is due to their reliance on brand partnerships, such a major brand partner as Nike is. So it's kind of interesting to think about. So yeah, maybe a little bit of a frenemy situation, but it's more that the point is that the health of Nike as a business directly correlates with the health of Foot Locker because they're so, intertwined.
Yeah, I'd want to put this chart up for people to look at really quickly here. As we're talking from Foot Locker, we'll get that up here in a second for you guys. That shows the stock recently. You can see again the purple line there is Foot Locker. The orange is S&P 500, right? And so yeah, if I look, so if I change this and I get a 5-day chart here, right? I'll see if that'll load up for you there. You see that big jump there. Maybe it's smoother if we show the month chart here. But we see, this run up here, right? With the recent earnings report there. But if you put this in context, right? Again, I'll go back to the year. You put this in context, right? We saw a little bit of a rise after earnings, right around here. But you've seen this kind of long downward trend over the past year. So I think a part of what we're seeing too, Rachel, in terms of the response to the earnings, because they reduced guidance, right? They tamped on guidance a little bit. It's not what you'd expect to see a rise, but I think what it was is like, well, this isn't as bad as it could have been idea, right? Like we all know that we've been struggling, and there are some things to like as you were just going through, and maybe it's not going to be a complete disaster here. Maybe there's optimism. So that's kind of why you see a little bit of a boost after earnings. I think it's always important to put the movements we see right around earnings, right, in context of at least a year of trends, because sometimes what we see is less about the report itself or even about the guidance, and more about how did this match up with our expectations given how things have gone, right? If it looks like it's a change in that, well, maybe it's not going to be as bad as we thought. Maybe things are going to get a little bit better. We see how we can see some improvement. You see that immediate rise, right? Even if the report might not look that great. If it's a change from the other side, right? Well, we've had a huge, year of just great returns, great earnings reports, stock is soaring, and oops, Maybe it looks like growth is going to be 15% instead of 20%. Sell off a little bit, right? So it's really about how that report fits in the context of expectations and how those expectations have been built up in people's minds over the past, the recent past, I think. So yeah, there's Foot Locker.
Yeah, that's an interesting one.
Yeah.
So there was a question that came in like a day ago, and sometimes these are addressed to other hosts, but when it's been a minute, we try to answer them as we can.
Mm-hmm.
There was a question about Warby Parker talking about expectations in the next few years, the potential impact of tariffs. I think this is a company you follow, isn't that right, Toby?
Yeah, a little bit. And this is let me just check here. When was their IPO?
Oh yeah, that was a bit more recent.
Recent? No, it's been a couple years now.
Okay, well, relatively recent. Oh, okay.
And not technically an IPO. It was via direct listing on the exchange. Which in the way that works, right, is so they don't actually put new stock out there. They just take stock that exists, that is owned in this case by insiders and investors, right, private investors, and that's just listed. Right now, it becomes public, and existing investors can trade those shares and sell those shares on the exchange, as opposed to the company actually selling additional stock out into the market, which we would find typically with an IPO. Someone selling something. This was just these shares are now listed publicly, have at it type deal. So that was like almost 3.5 years ago. That was
back when IPOs were still like happening pretty regularly, right?
Yeah, that was the post-COVID. Let's all go public.
Yep.
There. But Warby Parker, if people don't know about this one, this is an eyeglass maker, right? This is what they do, and we can even have more fun with this one because we'll do a screen share here for our viewers who may not be familiar with Warby Parker, although I feel like a lot of people are,
because they have an interesting
go,
model, right?
They sell, check it out, right?
Yeah, there you go. They sell direct to consumers.
They do. It's a direct to consumer model, and you can check out this is the stuff, right? You can go on their website, and what they do, right, it's a direct to consumer model, and you ask yourself, well, how does that even work? I'm not going to buy eyeglasses that I can't try on. Who in the world would do that? Well, what they will do is this home try on, right? So you can go and you can pick like 5 frames, and they'll send them to you at home. You try them on, look in the mirror, get your friends and family to tell you whether you look good or not, what have you. And then you pick one and say, I like this one, right? And I'm going to go, you send them all back when you're done. Like, this one looks good, right? I'll get this one, right? And then you send in your prescription, from your doctor, from your optometrist or ophthalmologist or what have you, and then they make prescription glasses based on that, right? And they have a mechanism. I think you can use like a credit card or something to kind of get your pupillary distance. You can go get that measured and send the measurements in as well from your doctor. Some doctors resist that because they're trying to sell you glasses themselves, right? And if you say, what's my pupillary distance, they know exactly you're going to go online and buy them, right? But there are ways you can do that with cameras too, to kind of get that close. But they'll get that in for you. And then you say, well, what if it doesn't fit exactly, or I need to get them adjusted? You can go to any optometrist and have them adjusted. Your doctor who gave you a prescription might do that for free. If they charge you for it, Warby Parker will reimburse a portion of that, right? Now, they also have stores too, right? So, Rachel, that started as pretty much a mostly online business, I think with 1 or 2 locations. And now they are expanding their store count. You know what? Sorry, producers here. I'll go ahead and throw the screen share up again as we're talking about this business. But look, so this is where their stores are now. You can sell, this. I can search this whole place, right? You can see them. They have some in Texas. They've got some in California. They're really all over. They have some on the East Coast too, in your more populated areas. But they have a lot of actual retail stores. And it's interesting. You don't go into the store and actually buy your glasses there, right? What you do is you go into the store, you try them on, as you typically would in an eyeglasses store. You got your prescription with you. You give that to a sales associate. They put that in the system, and they actually order the glasses online for you, right? You don't get them in the store. So the store is a showroom for the frames. They do have some locations that have optometrists in there that can give you an eye exam right then in the store. And if you have a prescription, they can also do the measurements on your face with equipment they have there. And every store can do that in there. But what they're really doing is placing an order online for you, and they ship to your house. Right. So it's a very nice hybrid model there. But yeah, it's an interesting business. What was the question again? I kind of got off track after this. We're just talking about the company here.
Well, the question that had been posed to the host a day ago was, are you still long on this? What's the potential impact of tariffs and expectations over the next couple years? I do think it's interesting, this direct to consumer model, and that they have that home try on feature, virtual try on, where you can go and see how it might look on your face before selecting frames for your house. It's interesting. They had just announced a collaboration at the end of February that they were teaming up with Target. So there's going to be these new Warby Parker at Target shop-in shops that'll offer guests designer quality eyewear as well as contacts and eye exams. They're planning to launch 5 of these types of shops in 2025 and open more in the years ahead. That's interesting as well. I mean, we know Target has been struggling a lot in the current environment, so I find that to be an interesting partnership. They're not profitable under GAAP currently. Revenue grew about 15% in 2024. That was about 771 million, just to give an idea of scale. Thinking about what this business will look like over the long term, I do think there's a real opportunity here that consumers like, the ease compared to some of the traditional methods of buying eyewear. As a wearer of glasses myself, thinking about the next few years, though, I do think this is very much wearing glasses for those of us who need them. It is not a discretionary purchase, and obviously a lot of us have insurance and things to cover these sorts of costs. But when it comes to maybe changing out your eyewear, if your current prescription is decent, that could be a situation where you see maybe consumers curtailing expenditures a bit in the next couple years. So, it's hard to say exactly what the impact of something like tariffs would be, right? And this is obviously something that is rapidly evolving as we speak today. There's been multiple stories about this. So I hesitate to really comment too much on how tariffs will impact a business when, as it is, the state of tariffs seems to be changing every other day, depending on what the news is. But I don't know if you have thoughts there, Toby.
Yeah, let me see here. Sorry, I'm just looking up. I'm trying to figure out where they make the lenses.
Yeah, I was looking into that too. I think that they had I think that when I had researched some of this, they had sourced a lot of their raw material from Europe, actually in Italy.
Yeah, the acetane,
which is interesting.
The acetane these are, I think, acetane lenses, not Warby Parkers. I have several. I used to wear them a lot. And love them, but recently switched to a new eye doctor, which gives discounts. And anyway, long story, I don't use it as much anymore. But so the acetane comes from Italy. The frames are manufactured in China, and so they get the frames in China. So what it looks like happens though, and so why is it important where the lenses come from? Because it matters whether or not they're getting the frames in bulk in from China, or they're making the prescription glasses there and sending them in, right? Because of that de minimis exemption, $800 or less. If I'm sending you eyeglasses, Rachel, from China, your prescription from China, then that's probably right now, because I think that was suspended but then reinstated. So I think right now there's no tariff on that if it's less than $800. But I don't think that's what's happening with them. It looks like the lenses are cut and mounted in the US. So what does that suggest? Is that we're getting our frames from China in bulk shipments, which makes sense, right? Because you're also going to have them in your stores, in your showrooms, as models there too. And you want to have them here so you can send in to people quickly for that home try-on thing, right? So it looks like when they come in from China, they're already well above the de minimis, I would imagine, because I suspect they're coming in bulk.
Yeah, I would think.
In bulk shipments there. And then the lenses get put on here, get cut and put into the frames here and shipped to the customers. So what does this mean for tariffs? It means that whatever the tariff is on China, it's 10% now. Did we change that yesterday?
I think it's 10% above and beyond, what existed before.
What existed before.
Yeah.
The frames are going to cost 10% more, I think is what that means. Ultimately, maybe they'll eat some of that. Maybe they'll pass it all on to the customer. But that's just the frame itself, right? The lenses, the labor that goes into assembling it, all of that would be unimpacted by tariffs. Now, the materials for the lenses, I'm not 100% sure on that. I don't know where that comes in from. There could be an impact there, but we do know there will be or is some impact on tariffs, at least with respect to the frames that they're bringing in. So yeah.
Yeah, it's an interesting, I think it's a good question. And, it's very much, I think, going to be on a case by case basis, right? Because these companies operate so differently sometimes.
I don't know if there is any eyeglass manufacturer that makes their frames domestically.
Right.
Aren't they pretty much all coming from China? Maybe a few other places, but I suspect this is going to be the scenario of everybody's kind of in the same boat here.
Maybe looking at the eyeglass space, yes, that I would agree.
The eyeglasses, right? So I don't know which of their competitors would be able to undercut them because they're not subject to tariffs. I don't know if that exists. I think we're pretty much all kind of, the whole industry is just going to have to deal with this, and therefore it won't be much of a competitive disadvantage. I mean, maybe it means consumers buy vanity sunglasses less, but if you need glasses, you need glasses, right? And like, people don't necessarily go buy glasses for fun, right? Like, it's not, I mean, like, it's not like I decide, I've had these for 3 years, I want another pair, right? I go buy when they break, or
like the prescription doesn't work. Yeah.
That's what's driving it. And at that point, it's kind of like, it is what it is in terms of costs. And what are you going to do? Now, maybe I try to push my prescription sunglasses a little bit longer, perhaps, if the cost goes up there. If I'm only wearing them in the car or on the beach, I don't care if my prescription changed a little bit. So I'll just get only regular glasses and not sunglasses this time. Or maybe I scale down in terms of cost of the frames. I go for a lower cost model instead of the higher end designer model, perhaps. So you might see some change in consumer behavior there. But I suspect people are still going to buy eyeglasses, like, even with a little bit of a 10% increase on the frames. That's kind of what you have to do with this.
There's a competitor of theirs. They're not publicly traded. I Buy Direct. I think they're headquartered in Texas, and they use like recycled plastics and recycled acetate and plastic waste from the ocean, for example, for their eyeglasses. And then, of course, there's different elements that they source from different suppliers. But it's very much, I think, dependent on the individual company as well. I think some of them have very different sourcing practices. And then, broadly speaking, when we talk about the impact of tariffs, it's so industry and company specific. And I think it's important to underscore that tariff news alone, I don't think should guide. It's not guiding my investing decisions. And I think is something to be really cautious with, because it's such a changing thing right now. What we're seeing is not something that I think we've seen before, in the sense of how a tariff is announced and then it's adjusted within hours. And there's a lot that's unknown. So I think it's important to pay attention to and watch way too soon to see what the actual impact will be, because it's unclear what the final product of some of these tariffs will be.
Yeah. Nice. We got Brian and Karl coming in, I think, for what I presume is going to be a healthcare/biotech hour here. As they're coming in, I do want to address KM's question from 3 minutes ago. General question: want to take my 2 kids to annual Berkshire meeting? Awesome. That's a good thing to do. short one ticket, anyone have this one to spare, how to get an extra? I think, KM, this is a great question to ask on the boards. Go to the Berkshire board and just throw it out there. Anyone have an extra pass? You might get some response there. If someone says, yeah, I got an extra one, I can mail it to you or whatever. I think this is a situation where you access the community and see what fellow fools can do for you. But with that, Karl and Brian, take it away.
All right. Thank you very much. Brian, good to see you again.
Yeah.
Let's see, before we kick straight into questions, do you have any general topics you wanted to address first?
Yeah, ABBV is getting into the obesity market. They license a drug from a private. Oh no, it's a company that's listed on the Copenhagen exchange.
Yep.
And they paid quite a bit for it up front. It was like $300 million or something like that.
Yeah, 350.
Yeah,
one of those.
Something like that.
Yeah. I'll just put in a plug even before we get into that, just to say, when you see these headlines in the industry, you often see these massive numbers. So you'll see something like, AbbVie enters into $2.3 billion deal for obesity with, XYZ company. And it's just important to realize those are what are typically called bio bucks in the industry. It's the maximum possible payout that could happen if absolutely everything went as well as it possibly could go. So sometimes it would be like, we have a drug discovery deal, and if they, develop 6 successful drugs from all the targets we're talking about, and they all hit these it's sort of, generally speaking, not really a realistic number. It's a guideline for where things could go. So usually you look at like, well, what are they actually paying up front? So in this case, this is exactly that. It was put forward as a $2.something billion deal, but the upfront was $350 million. So that's still a significant deal. Don't get me wrong.
Considering it's still in phase 1, and they've only done single ascending doses. So patients got one dose, and then the next patient got a higher, the next group of patients got a higher dose, and the next patient's got a higher dose. And the weight loss was about like 3% compared to a gain of 1% for patients that got placebo. So,
right.
It seems to be working, at least, with one dose, but we don't even have enough safety data to know how this thing can perform. So, I think it's pretty early stage, but it just shows the potential upside of obesity drugs and how they're being valued, even though this is a very early stage. I think it was an amylin drug.
Yeah, it's another amylin or amylin, however you say that. Which I think is also interesting, and just to put that in perspective, amylin is a target that's kind of known to be another satiety hormone. There's been a product on the market for years, but it's called pramlintide is the name of the drug, but it's not very widely used because just the molecule itself, much like GLP-1, the human version just doesn't last very long. And even the engineered drug version, of pramlintide, you had to inject 3 times a day for it to work. So it just didn't get very much used. So now, the basic idea is people can design better molecules with longer half-life, and so that you can get more of the impact of these. But it's also pretty crowded. I am a little surprised by the amount they were willing to pay for that. Obviously they're doing their due diligence and they're seeing data that we're not seeing. So, I don't know what they're seeing. They're encouraged by something. We saw with Novo Nordisk coming out with their CagriSema results. Remember, so CagriSema was one where it was combining its cagrilinotide is the cagra part, and semaglutide is the sema part. It was basically adding in an amylin mechanism on top of semaglutide, and it was good. It was a very potent drug. It was kind of online with Najarro, but one thing that I don't want to read too much into the limited data that you could see, but it was sort of a like the sum is less than the 2 parts. In other words, what you would expect from the amylin and what you would expect from the semaglutide didn't add up to, those two. You didn't get quite that much oomph out of them as a combination. And so that's going to factor into how these drugs get used, which is not to say it doesn't look like a promising area for future drug development. I mean, I think that, in the future, you'll see probably a variety of drugs, and they'll make sense for different people, and hopefully we'll figure out more about that, like what works best for who, and also just see more long-term sort of safety and side effect data on this that gives us a better idea of who can benefit most. That was a mouthful. I came up, just because Viking Therapeutics got knocked back again when that deal came out, because it's, again, anytime a big pharma company makes a deal with anybody who isn't them, everybody gets disheartened because they're hoping that Viking will get acquired.
Yeah. And it was kind of interesting. I don't know. It was weird that we got rumors that Pfizer was interested in them a couple of weeks ago, but and they jumped on the stock jumped on that report, but from unnamed sources, and then it turned out, it doesn't seem to have happened, at least not in the last 2 weeks or 3 weeks since we had that report.
Right. Yeah. And we don't know what's going on. I don't know, it's hard to tell if Viking is driving a hard bargain, if they're just not, getting the level of that these rumored discussions that we're hearing are taking place are just not taking place. There's a lot that we don't know. I will say that Viking, they need to do at least a sort of manufacturing partnership. They can't just completely go on their own for this. Right. So at some point they're going to have to partner with somebody in some regard, and they might be looking for some very specific terms that they're not getting yet. We will not know until we know.
Yeah, the other thing is they can be. If it's an acquisition, they could be anchored to the 50 the all-time high, which they're off considerably from that. So a lot of times management doesn't want to get taken out for less than what they were previously trading at. Even though that's just a historical number that doesn't really mean a whole lot. But
in an environment that keeps changing, and not necessarily in an encouraging way.
Yeah.
Just one other thing I just thought was kind of noteworthy and maybe worth a little discussion is the final demise of Bluebird Bio. I don't know if you saw this, but Bluebird Bio is being taken out in a private equity deal. So they're being bought out for $3 a share upfront, and then a contingent value right that is worth $6.84 a share if net sales reach $600 million at any time in any 12-month period before the end of 2027. So that's quite an end to an incredibly successful company in terms of its science, and an incredibly unsuccessful company in terms of its ability to commercialize on that. And I think it's kind of a sad story, and I think it says something about the spot that we're in, and particularly says something about the future of gene editing and gene therapy drugs, and how this is going to shake out. Did you have anything you wanted to?
No, I think it's sad, especially considering the valuation of the company. Let's say five years ago. It's kind of crazy how basically it went to almost no value. Of course, they spit off their other product, their cancer products, into a new company, and so the value of some of the value of the company went with that. And the shareholders got shares of both companies. So It's not quite as bad as it looks, but I don't know. I saw somebody.
Well, just about, because 270 didn't do very well either.
Yeah, so somebody posted that the CEO had sold more shares, in its heyday than the price of that it ended up getting taken out for. So, that's just, it's kind of scary, sad.
Yeah. Yeah, and I mean, I guess you could say, I mean, certainly Bluebird's been in a very, very distressed position for quite a while. So, I mean, in one sense, you could say that this isn't super surprising, but I guess the larger picture is it's just sort of, you know, why couldn't the company be more successful, and why, you know, when they finally crossed the finish line with a product that should have commercial traction, like why can't they find a better way to raise the money needed to make that happen? And, you know, I mean, to some extent, the answer is that there's just a lot of doubts about the viability, I think, of one-time cures. So I'm not saying, you know, this, yeah, I mean, it's just the sort of the one-time cure model is not really super catching on, for, you know, reasons that we've talked about in the past. But, you know, it does raise concerns, I guess, about other companies in the gene editing space, and even, you know, the approved competitive product from CRISPR Therapeutics and Vertex. I mean, Vertex is in a fine position. I mean, they're going to be fine no matter what happens with Cascaved, but you know, certainly CRISPR Therapeutics is on the hook to keep putting in 40% of the expenses towards this. So let's see. I mean, you know, the private equity groups that took out Bluebird are obviously hopeful that they can, you know, do something with these products. I mean, when you looked at the last time Bluebird reported anything was in last November, and I think they said they had 74 patients who had started at least cell collection. I mean, if you just nominally take that and multiply it out and just say 74 patients at $3 million a piece, I mean, that comes out to like $230 million, which is, you know, that's not going to make them profitable by any means, but I mean, that's, you know, that starts to look like real revenue. It's just not what people expected.
Yeah. I mean, the other thing is I would imagine the private equity is going to gut any research and development they're doing. So that will help them get closer to profitability, because they're not going to probably be doing more research. They're probably just going to try to sell this without selling, you know, without doing any research to develop more products.
Well, right. In the case of Bluebird, I mean, you've got 3 approved products. There's plenty to be getting on with without even bothering to do more R&D.
Right.
All right. Well, on that bright note,
So we had a couple of questions on RXSight. The ticker is RXST over the last couple of days, so I wanted to get to those. It's smaller cap. They reported earnings a few days ago, you know, maybe a week or so ago. So this company is really interesting. So they have lenses for cardiac eye surgery. So you have cataracts, and then you need to the new way of doing it is they replace the lens basically with a new lens. And so what they have is a lens where they can adjust the amount of light that can come through. And that seems to help with the ability of the new lens to actually be able to work, and the patient can focus at the right depth, and therefore they can they don't need, a lot of them don't need glasses anymore. So kind of a semi-remarkable, you know, thing. I mean, I hadn't heard about this company, and it you know, it seems they've been around for a little while, and they've had not 29,000 procedures in the fourth quarter. So not too bad, and they sort of have a razor and blades model with the blades being the lenses, but they also have a device that is used to adjust the light for it, and so you can figure out how many doctors are using this technology based on the number of these light delivery devices that they have that have been placed, and so that went up 46% in the fourth quarter. They placed 83 more they placed the 83 more in the fourth quarter, and so if you compare the end of the fourth quarter of 2023 to the end of 2024, they went from 666 units to 971 of these light delivery devices placed. So quite a bit of an increase in the number of doctors using it, and you would expect that would continue to result in increased number of procedures that are being done with the thing. So company has 200 and not profitable, but the company has 237 million in cash. So doesn't seem like they're likely to run out of cash anytime in the near future. Their net loss was only $5.9 million in the fourth quarter. So, plenty of quarters of cash sitting on the books. So it doesn't, and they're pretty close to being profitable. So overall, it seems like a pretty solid company. They're guiding for revenue growth in 2025 of 32 to 41%. So, I think overall it seems like a pretty solid company. If you look at the valuation, the growth has come down over the last few years, which is not surprising. Obviously, when you're starting off with nothing, the growth can be really quick, but as you increase your installed base, you've got to, continue to grow by it, continuing to get it installed bases, but each one of those new installations of the light devices, those are going to adjust the lenses that are sold off for each one of those is going to be off of a larger base. So, but the price to sales ratio has come down substantially in the process as well. So it doesn't seem like it's that bad overall. And the valuation, the stock price has taken quite a bit of a hit, and I can't really tell why, but it was trading up in the mid 50s, and it's down to $26 a share right now. And obviously the price to sales ratio has come down over that time frame, because the revenue has been going up, so and the price has been going down, so that's helped the valuation look a lot more attractive. So first pass on this company, and I spent 30 or 40 minutes on it. Looks pretty good. I'm not ready to quite buy yet, but I think it's definitely worth putting on your watch list and learning more about the company.
So you looked at this more closely than I did, but I just from what I know about it, the technology is really cool, and I kind of like the model of it as well. And it's certainly, cataract surgery is it's one of those things that, most of us should hope we get, because it just basically means you've stuck around long enough that you need it. Most people need it at some point. So, in that sense, it's also a very sort of stable and safe market, and certainly linked to aging. I guess my only thing is, I know it's pretty expensive. Like, it can run up to like $50,000 an eye. Is that?
Yeah, I haven't gotten into that, they definitely seem to try to, they try to get doctors to use it as, the same way Intuitive Surgical did, right? Where there was like, hospitals should buy this because then they'll be able to compete against their neighboring hospital that doesn't have a Intuitive Surgical device. They seem to in the investor deck that I saw a slide that basically was hinting at that they try to get one doctor to do it in a region, and therefore they have the advantage of having this technology where the other doctors in the region don't, and then that drives adoption, because then other doctors want to be able to compete and offer this as an option. And so
yeah. So my only thought would just, and this is by no means a knock on the company, which looked pretty interesting, but just to look at it is obviously I think there's an important Medicare element there, and just to make sure, just look at, like, are you seeing heavy growth among private insured, and then you start to come up against some limits, and what is Medicare going to do? And I'm just saying I'm just throwing those out there without knowing the answers to those questions.
Yeah, no, I think that's definitely good thoughts on that we should think about.
Yeah. All right. Let's see. You have another one you want to hit?
There was one on on ClearPoint.
Okay. And it comes from Brian Fan, so there you go.
Yeah, Brian Fan. So Brian Fan asks, do you guys have any thoughts on ClearPoint Neuro, ticker CLPT? So I looked at this one a little bit while you were on a rant for something. So this company has a lot of deals with drug companies. So they're basically, I mean, they can use their devices for a whole bunch of things, but I think maybe the most likely, for long-term growth is the delivery of gene therapies that, into the brain and the spine. And so they have maybe 60 different partnerships. Yeah, 60 plus partnerships with biologics and drug delivery companies. And so that, I think, is their most likely potential for long-term growth. The problem is that they're 100% dependent on the biotechs getting approval of their drugs, and then therefore the device, the NeuroPoint's device will be the ClearPoint's device will be the only device that's used to deliver that drug. But they've got to get the drugs approved, and they've only gotten maybe, I don't know, 1 or 2, I think, approved. And so their sales are pretty minimal, and they only got like $20 million in cash or something.
Yeah, that'd be the main thing I would keep an eye on. I mean, I will say they do have a very tightly controlled burn. They're not burning through cash very fast, but they have very little of it. And so that is definitely where I would watch carefully. And in a better environment, I would think that they've got enough going on with partnerships and otherwise that they would, be able to raise money and move forward. But I'd just be, it's a little more of a concern now where financing seems to be so difficult. My only other hot take, and this is just speculative and long term, but I think that Intuitive Surgical is going to move into this space eventually. I mean, they're already talking about different applications of their Ion endoluminal robot, which is the robot that's used for lung biopsies using these flexible catheters, these like really, really incredibly manipulable catheters. Those catheters right now, they're like 3.5 millimeters. They're too big to go and do neuro work, but I think they could use that platform and kind of, you don't have to reduce the size an order of magnitude. You knock them down a little bit and you've got, some delivery technology there. Obviously ClearPoint Neuro's doing more than that, but that's a potentially competitive area somewhere down the road. Nevertheless, I don't think it's a bad company.
No, yeah, I just think at $362 million market cap, there's potential for dilution that could result in, if they have to raise another $20 million, then that's gonna be a substantial, more than 5% dilution. And that's $20 million is not raising a whole lot of capital. So, I think they did a $16 million raise last year. So I think I think I would definitely watch the cash, and this is, and it's going to take a while for them to get to the point where they're in hyper growth mode. They're going to have to wait until they have, a whole bunch of drugs on the market, and then they'll see some, so the partners get a whole bunch of drugs on the market, then they'll see a huge increase in doctors setting up these delivery systems for these drugs. But right now, there's no market. The market for the delivery system is pretty minimal.
Yeah. We have a question here from Ed. It says, I don't own VRTV, but is this a stock you follow? Is it a good value? Ed, if you're on, you might just want to clarify what company you're talking about, because I don't know VRTV.
Yeah, I could only find a company that went out, that either got acquired or went out of business a few years ago that had that ticker. But
yeah, there's a company. Yeah, I think so. My guess is that he means Vertex, VRTX. That would be the closest ticker. It's possible he means Verve Therapeutics, which is partnered with Beam. But I'll answer for Vertex because I think that's the most likely answer.
V and X are right next to each other on the keyboard. So
yeah, exactly. I mean, Vertex is in the biotech world, it's pretty much a blue chip, and in fact, you could start looking at it as a pharmaceutical. It's getting to sort of pharmaceutical company type levels in terms of its revenue and profitability and cash and all that kind of stuff. I mean, it's a pretty stable and reliable company. So we've talked about it. I mean, we were actually talking about it a little bit earlier here because we were talking about some doubts about its venture into treating sickle cell disease and beta thalassemia. But that is for them, fairly small potatoes, except to the extent that they're losing a ton of money right now trying to build that market. I do hope that they can be successful. But they trade off of their cystic fibrosis franchise. They are, essentially a monopoly in the treatment of cystic fibrosis. They have really the drugs that everybody uses. They have done, I mean, really, I think they deserve a lot of credit for doing right by patients, right? They didn't just focus on hitting the bulk of the market that's most profitable. I mean, they really have gone through and tried to make sure that no matter what mutation you have that leads to cystic fibrosis, they have something that can help you treat that. And they've kept plugging away at trying to make the drugs better and better to the point that I'm not sure there's much anybody else is really even trying to catch up to them on that level right now. And that includes even, they have stuff in the works for people who just do not produce any CFTR at all, right? Which is their program with Moderna. I think that's right. Rather than all these specific mutations around it. So, I mean, a great company in their core business. Brian and I have talked a little bit about having some doubts about their new pain drug. I mean, it certainly could be good. It's certainly a huge market. It's something like 80 million procedures a year that they could be addressing with this acute pain drug. And just, if you're not following that, this is a drug that addresses pain, but it's not an opioid drug. So in other words, you get rid of the euphoria, but also the addiction risk that goes with opioid drugs. That is obviously a good thing if you're a physician worried about, the implications of opioid prescribing. It's a great thing if you've had past struggles with opioids and you want a painkiller, but you don't want to be using opioids. To me, it's always been a little bit of a question because those are typically situations where you'd be handing people, 5 days worth of pills or something like that. And, that's generally speaking, not an addiction risk. And obviously this drug is many times more expensive than that. So it's to me, it remains to be seen how well that plays out in commercially. The real promise would be if you have a chronic condition where you need to chronically be on pain medications for a long period of time, then, opioid addiction becomes a risk for anybody who just has to take these things over a long period of time. So that's where you really want to see this play out. And the clinical results they've had so far have been a little equivocal. Last one that I saw in sciatica was not impressive. So there's a little bit of a question around there, but they're building out their business in kidney diseases that looks promising. They're building out their business. I mean, they're looking at a treatment for type 1 diabetes. So it's a really it's a great company, and I think is also a pretty stable one.
Yeah, I think the one knock on Vertex, and I'm a shareholder, is just the valuation right now.
Right.
I think it's gotten maybe a little bit ahead of itself. And if the pain drug ends up being very, very successful, it's probably undervalued now, but I think that there may be a little bit too much of the pain drug priced into the stock already, and so maybe if it's a slow ramp or a medium ramp, it may actually end up we end up getting a pullback. Interestingly, the Vertex has gone above Bristol Myers Squibb in market cap recently this year. So the market cap right now is 124.75 billion for Vertex, and Bristol Myers is only at 120.5. Some of that's because Bristol Myers has come down, but also Vertex has just been on a tear over the last 6 months, and then especially since early 2024, and then Pfizer, they're approaching Pfizer level, which is at 150 billion right now. So just it's definitely becoming a large pharmaceutical company rather than a biotech, in the traditional sense of the definition of biotechs.
All right. Let's see. We do not have a ton of questions new coming in, but I just looking back. Here's one of the oldest questions on the list. This is from 2 weeks ago. It's kind of interesting. It's a slightly different area. Edward Albridge asked about MPW. MPW is Medical Properties Trust. It's a REIT. And it's a REIT that specializes in healthcare facilities. So this would typically this would typically say own hospitals, say, and then you would be, the landlord essentially to a hospital tenant. I don't know a whole, a ton about the business, but I mean, I know this much. Right. I mean, first of all, it's highly international. Reasons that you might be interested in a healthcare REIT over other REITs, I mean, it's just diversified very differently, right? I mean, you're not counting on, obviously things like retail REITs had problems around, obviously that was a tough place to be during COVID. If you owned a bunch of malls, say, that wasn't really a great business. Or if if hotel REITs that have had some disruption from Airbnb, data center REITs have obviously been very hot. There's all kinds of different areas it can be in. I mean, healthcare comes with its own advantages and disadvantages. One of the advantages just being that it's not, it tends to be economically stable. It's not super reliant on economic cycles. People need healthcare when they need their healthcare. And it's also, somewhat resistant to some of the concerns about other places. I mean, you at some point, if you need to see a doctor, you need to see a doctor. You need to do it in person. You need a facility to do it in. Telehealth has kind of changed some of that, and I think that they've a little bit changed their focus so that it's maybe not so much just hospitals, but also smaller facilities that kind of take into account some of that flexibility. So if you are in the REIT interested in investing in REITs, I think it's it makes some sense to diversify out into that. The sort of downside for a medical REIT like this, and it's something that this company has experienced. Again, this is MPW, Medical Properties Trust, is bankruptcies of some of its tenants, right? So if you do have that, I mean, that does happen with hospitals from time to time. And, as a tenant, I mean, as a landlord, you do have some obligations to your tenants. You can't just say like, well, you didn't pay your rent, so now everybody's kicked out of the hospital, right? I mean, you can't do that. You have to make this work out. Okay. And that does mean some financial risk. And in fact, they have suffered a series of bankruptcies that did cause their revenue to drop, and cause them to lose a fair bit of money. And so right now, I think they're kind of viewed as a turnaround play. And that's about as far as I can go on that right now. I mean, I haven't, really evaluated whether I think that looks like it's sustainable. I mean, I think things have improved, but as to whether it's sustainable or not, that's something to take a look at. But I mean, that's kind of why you would maybe want to be in that space.
Yeah, I wonder about investing in that versus investing in like HCA, where you're not only getting the properties, but you're getting the whole kit and caboodle, and getting all the different doctors, and hospitals.
Yeah. Yeah. I mean, it's a different kind of diversity, I guess, right? I mean, MPW owns facilities all around the world. Like, it's not just it's just not just the US, it's all over the world. So, I mean, you have that kind of diversity, but yeah, I mean, it's different.
Right. Yeah. No, I just wonder, like, in terms of, potential growth over the next, 5 years, which one can outpace the other one. I mean, it's, maybe getting less, you may be getting more risk with HCA, but more potential reward.
Yeah. So I don't know if I just got an award for answering the oldest question, but
Yeah.
do you have? I've got another old one. Unless you've pulled up something you want.
Just Luella asks about any thoughts on what we should be watching with Novocure, tickers NVCR. So they've
Oh, there we go.
gotten they've gotten approval for non-small cell lung cancer, and that product, which is called Optune Lua, is rolling out right now. So I think that's the main thing to watch in 2025 is how well that, or how poorly that launch ends up going. I think that there's not much priced in, so there's probably more upside than there is downside to that launch. So again, I mean, in case you have forgotten, the company, the study was positive in that Optiluna worked better than not having Optiluna, but Optilua, but the Optune Lua. There we go.
Yeah.
Too many vowels in the name. But the standard of care has changed since then, and so it has an approval for standard of care in first line usage that doesn't actually happen right now. And so the question is, will doctors prescribe it alongside immunotherapies, or will they wait and see whether, when the Novocure eventually gets a clinical trial for comparing Optune Lua with immunotherapies compared to immunotherapies alone, and see whether it improves survival. Until we see that data, will doctors wait, or will they just go ahead and, even though it's prescribed not, it's approved not in combination with immunotherapies, because the immunotherapies are used as a first line treatment, will that it get prescribed straight away. So I think that's the main thing to look for. They also late last year got positive data for pancreatic cancer, and so they're going to have to get FDA approval for that. So that may be a 2025 event, but the launch isn't going to be won't be substantial until 2026. And then they have two clinical trials reading out, but both of those won't read out until 2026. So they have a phase 3 study in newly diagnosed glioblastoma, which could increase the usage in glioblastoma. And then
I think that one's looking at, basically, instead of, is like a sort of a neoadjuvant study, right? So they're looking at, I don't know if that's the right term in this context. They're looking at giving it at the same time you start radiation therapy, rather than doing it afterwards, I think is what that study is. So I mean, I guess that one's probably, to me, I mean, that seems like that's maybe incremental in terms of the impact it would have.
But they don't have, I mean, there's still quite a few patients, glioblastoma patients, even though it clearly works in glioblastoma, there's still a lot of patients that don't use it, right? So there's still opportunity, even if though obviously glioblastoma is a small market compared to pancreatic cancer or lung cancer.
Yeah. Just timing wise, I mean, they've said they're going to submit for FDA approval in pancreatic cancer this year. So obviously, watch to make sure that really happens. And also in brain metastases from non-small cell lung cancer, that should happen. The filing should happen this year. I'm not saying the approval is going to happen this year. So, watch for that. Yeah, with Optune Lua, I guess the encouraging things is from the, it's a new launch and the expectations were very low, but they have had some people in, and they have said that they've got a mix of people, like how they're being treated, including some people who are going in on checkpoint inhibitors and Optune Lua. And those are the people, I'm hoping that they can get some at least anecdotal data out of this that because those are the people who did the best in the trial. And that's not strictly speaking, I don't, it'll be interesting to see if some people don't, strictly speaking, go in as second line. Some people are going in being, it sounded like from what they were saying, treatment naive on checkpoint inhibitors, which and doing this, which sure sounds like first line treatment to me. So it'll be interesting to see what kind of data they can glean from that. The stock had a negative reaction to their latest earnings. And I mean, in part, we're just in a negative spot right now. But I mean, if there was any reason, I was really looking at them like, did they say? I mean, didn't really say much that should have been super surprising. I mean, revenues came in right where they were expected to be. I mean, the companies, one thing I will say that's good about Novocure is that although they're not profitable right now, I mean, they do have plenty of cash. Like, they're not in danger of running out of cash or even really needing to finance anytime in the near future. So I just seemed to me, they just seem sort of incrementally a little more negative on getting past this sort of 40% penetration threshold in glioblastoma, right? With this idea, because it's really more patients should be using that product than are. And there was always this idea that, well, with education, with this, with that, they can increase that number. And it just seemed a little more pessimistic, even though it wasn't really a change in messaging.
Yeah.
Ultimately it's going to ride on future indications rather than growth in glioblastoma.
Yeah. So, I mean, that's always been the investment thesis,
Right.
I mean, for years, that's been the investment thesis. So, I think they're moving in that direction, but, it's certainly not as quickly as investors would have hoped if the clinical trial had been a better, if the lung cancer trial had been a better trial and hadn't had this issue with the changing of the standard of care, they would be in a much better position and probably higher valued. But yeah, just speaking of their cash, they had 960 million at the end of last year, and their burn rate their net loss for the fourth quarter was 66 million, but some of that's going to be non-cash, stock expenses and stuff like that. So they're burning less than 66 million per quarter, and they've got 960 million dollars in the bank. So plenty of cash to get through, launching the lung cancer product and presumably even the pancreatic cancer.
All right. There is a question from, hey, you are welcome, Luella. There is a question from Vihan, who's asking about Performant Healthcare. Vihan, I know you've asked about this before. I think we've even talked about it briefly before, but I think it might have been a time when you weren't on because you had asked it earlier. I'm not sure. Anyway, Performant is a company that specializes in what they call payment integrity, eligibility verification, and related analytics to healthcare payers. So basically the idea is, healthcare payers are paying out a lot of money. There's, a lot of claims get processed and mistakes happen. And so you're looking to make sure basically that you're not doing, incorrect payments, that there's not, it's not even necessarily so much a fraud and abuse thing as it is just just looking for problems in your system. It's a business that it's something where large companies are going to do this both internally, it's not that a huge payer is going to just outsource this entirely to a company like Performant. They're going to do it internally, but they may do a hybrid where they're doing some of it internally and they're outsourcing some of it. My sort of 30,000 foot view of it is just that I do think it makes it a tough margin business for them. I mean, they can't. When you're basically doing something for a client that is also doing it for themselves, it doesn't give you the greatest pricing power in the world. So that would just be one thing I think to keep in mind on there. And I'm just going to pull this up here. I don't know if you have any thoughts on this.
Yeah, no, not really. It's sort of outside of my wheelhouse for sure.
Yeah, I mean, long history of losses. I mean, their gross margins aren't terrible, although they've gone down. I mean, that's another thing I would like to understand with them. So, I mean, they were running gross margins over 70% back in 2020, and those have gone down every single year. I mean, they improved a little bit in 2024, but I mean, they've gone down, from 71% to 61%. That's a pretty steep drop in gross margin. And they've been losing money the entire time. They've got $20 million in cash, and a $391 million market cap. Again, the $391 million market cap is over 10 times trailing revenue. It's over 10 times projected revenue for 2025, despite losing money and not having a whole ton of cash. Just looking at their cash flow statement. Yeah, I mean, cash flow's marginally better than reported net income. So, they're not like in imminent danger of running out of money, but I would certainly, be worried about a dilution event or something else. Oh, wait a minute. I'm sorry. I've got Hey, Vihan, just ignore everything I just said. I am looking at the wrong thing. All right. This makes a lot more sense for this because I was wondering how they were running such high gross margins. I apologize for that. I had the wrong thing pulled up. Okay. Yes. Performant Healthcare actually also has declining gross margin, but declining from a much lower level. So this makes more sense with what I was thinking about this business. They were running gross margins in the 36% area back in 2020. That has dropped down to under 20% in the last few months. So that's interesting. They also have been reporting losses right along the way, but much lower log. A $213 million market cap. They have $7.8 million in cash. $7.8 million in cash, and they reported a net loss of $8.1 million over the last 12 months. Now, they did have marginally positive cash flow from operations, but free cash flow was negative. I guess, I know you're interested in this company. I mean, if you want to just put in what it is that is interesting you about it, because I'm not going to pretend that I know this business super well. I mean, I'm just looking. First I was looking at the wrong numbers, but I'm just looking at the numbers now. I'm not seeing I'm seeing things that worry me more than I'm seeing that anything attracts me to the business. But, if there's something that you're really focused in on, let us know, and maybe there'll be a different perspective on it. I would be concerned about their burning cash. They have virtually none. They actually have slightly more debt than they have cash. They're running low margins. And I don't see them having much pricing power. So there may be another story there that I don't know about.
Did you have another one from before? Otherwise, I have one that I can sort of briefly talk about.
Well, there was a question from, like a week ago. I mean, because I went to the very bottom and I started working my way up because I don't know why. Because old questions deserve answers. There was one about Abcellera. I'm just looking for the exact question. Yeah. Oh, actually, here I just found it. This was from Michael Coate. It was asked a week ago. It just says, "Is it time to revisit Abcellera?" ABCL is the ticker. You know, I again, I'd be interested to know what is it like revisit it because we should be more interested, or revisit it because we should be less interested? I'm not sure. Abcellera is maybe a company that's gotten a little more attention in sort of an AI context, because I think they've had sort of that reputation. I think to the CEO's credit, he's kind of downplayed the AI angle, but you know, there's certainly a data-driven approach to doing antibody development. I mean, the basic thing with Abcellera is they have a ton of partnerships, but they have virtually nothing of their own. I mean, they have stuff that's in the works, but it's all preclinical. So they're so far from being able to hit a commercialization spot. And now I'm really sensitive that I'm pulling up the right thing before I look at it and start talking. Yeah, revenue, you know, is not significant, and losses are, you know, reasonably significant. It's just, they've got, so, I mean, I'll say this for them. I mean, right now in this environment, I would just, there are biotech companies that are sort of early-ish stage that are burning cash, and if some of them will make it through, but it's just, until you see some improvements in the environment, I would just stay away from companies that aren't either already commercial, close to commercial, or have a ton of cash, right? I mean, that's kind of where I would tend to put my focus. Abcellera does have a fair bit of cash. I mean, they have over 600 million, so they're in no danger. So in a sort of like a you know, let's get on with it and survive the nuclear winter. You know, I think, you know, they look like there's a decent chance they could do that. But that's, you know, they have a fair bit of cash, but like they're pretty far from being able to change the trajectory based on their own programs, and they are burning a fair bit. So I guess I'd just be, you know, it's certainly not the most dangerous company out there, but I would guess I'd be a little bit cautious about it. I don't know. Any thoughts, Brian?
Yeah, I mean, I think the main issue is just that, going back to, well, I think maybe what we let off on, is that when you have all these deals, you don't know where these biobucks are going to come in, right? So they have something like 87. They have 87 partnerships, and 13 of them are in the clinic. So, you know, where exactly are the milestone payments that they get from these 87 or 9? I'm sorry, I was looking at 2023. So they have 96 partnerships at the end of 2024 and 16 molecules in the clinic. So, you know, that's a lot of partnerships and a lot of potential programs that can generate revenue to fund their pipeline, which, as you said, is very early stage and will definitely need a heck of a lot more cash in the future. But this is one of those companies that's really hard to value, because you don't know when that cash is going to come in, and, you know, what milestones they need to meet. You know, are they you know, phase 2 clinical trial successful? Are they approval of the drug successful? Are they, you know, meeting, you know, hitting $100 billion in revenue, you know, get you another milestone payment? And then, you know, how much, you know, you can probably go back and look at all the different announcements and see, you know, how much they could potentially have, but you don't know. You know, usually those things are back end weighted, so that makes things challenging, because you know, probably, right, you know, there may be one if it hits $5 billion in sales. You know, they get a $1 billion in as a milestone payment or something, or 500 million as a milestone payment. But what's the chances the drug's going to hit $5 billion, in annual sales?
Yeah. And this is one where, revenue, they had a huge windfall during COVID when they, made the antibody for Lilly, and that sold a whole bunch, but, fell off the cliff after 2022. Yeah, they'll continue to have some revenue ticking in probably from these partnerships. And this is, I just want to say, this is obviously a company that has some valuable technology and that partnerships find a lot of value in. And their model is a model that worked for a long time. It's not unsensible that they went about things this day. It's just that it's really, really hard right now. The basic model is look, we have a great sort of platform technology that lots of people want a partnership. We're going to do that. We're going to get a little revenue in that way. We're going to get some downstream revenue, hopefully from milestones and from royalties that kind of keep things ticking along while we advance our own pipeline. That sort of approach worked for a lot of companies for years. And it's just harder right now. That could turn around and all of a sudden this looks really, more attractive when you start to see that they're going to be able to bridge some of these gaps a little bit better. But right now it just looks like there's better risk adjusted places.
Yeah. Do you have the valuation? I don't know what's market cap.
The market cap is 712 million, but they have 625 million in cash.
Right.
So and a little bit of debt. So their enterprise value is 151 million. And you could say, well, enterprise value of 151 million. They brought in nearly 30 million in revenue last year from partners. I would imagine that all these sort of, they've got probably a ton of milestone events that could play out over the next few years, which probably makes revenue very volatile. But there's still going to be stuff coming in. But yeah, it's just that they're not anywhere near not burning cash.
Yeah.
All right. Do we have time for maybe one more before I know we've got a we got
a live interview coming in a few
Well,
minutes.
here's it looks like we only have a minute left. So I have a super easy one I just found here that's an older one. This is from Jimbo, has a question from a week ago. It was addressed to Rachel, I guess, but it's asking if Sarepta is selling isotope for medical imaging and diagnostics. No, they're not doing that. Sarepta is in the business of actually, Jimbo, looks like Jimbo's on right now. He had a more recent question. I should have answered that one. So sorry. Let's skip to that one and see if we can do that real quick. Are they in the tariff world? Well, Eli Lilly is domestic, so not really. But if European tariffs go into effect, then you're going to, obviously that, kind of hurts everyone. Right now, not so much. You're talking about Eli Lilly selling out to the rest of the world and Novo Nordisk, trying to come into the US from Denmark. All right, let us leave it there. And let's see if we've got, let me get back to my screen here. Andy is on.
Hello, gentlemen.
Hey.
Hello, Asit.
All right. Well, this one
Andy.
Looks like it's going to be interesting. So I'm just going to sign off and start watching you guys.
Gentlemen, great. Thank you very much.
Thanks.
All right. Bye.
Welcome, fools. Hi, Asit. Welcome to another hour of Fool24, and welcome to a special Motley Fool conversation. I'm Andy Cross, joined here by Asit Sharma from the Stock Advisor team. And we're really thrilled because we have a real treat today. We have Dr. Oren Etzioni. Welcome to a Motley Fool conversation. Dr. Etzioni is a co-founder of a new Seattle-based artificial startup, Vercept. He's also a pioneer in search and online comparison shopping, machine reading, open information extraction. He was the founding chief executive officer at the Allen Institute for AI and served as a CEO, chief executive officer from 2013 to 2022. He's a professor emeritus at University of Washington. He's founded numerous businesses. He's an entrepreneur that have been acquired by companies such as Microsoft and eBay. Gosh, what a resume. Dr. Etzioni, it's great to have you. Welcome to the Motley Fool. Thank you for joining us.
Well, thank you, Andy. Very kind introduction. And what a nice way of saying that I'm so old.
That is not true, sir. That is a very accomplished, and you certainly have experienced and seen a lot, but we're really thrilled, especially this day, to talk to you about, gosh, artificial intelligence, talk about research, talk about entrepreneurship and starting businesses, selling businesses. So we have so much to get into. And Fools, please, we'll be taking questions for Dr. Etzioni over in Slido. The code is Fool24, so please go there and we'll see some questions and we'll get to those questions too. Dr. Etzioni, maybe to start, I'll just reflect on a 2024 New York Times article from last year where you said you were once an optimist, where you said you're an optimist about artificial intelligence. That was just last year. So if 10 is totally optimistic and 1 is completely pessimistic, where are you these days and why?
Well, I'm ambivalent, to be honest. So on the optimistic side, I'm absolutely at a 9 or even a 10, simply because we're seeing self-driving cars. We've been promised them for a long time. They're coming to the fore, right? You can actually get in one in San Francisco and Phoenix and in more cities every day. And these save lives, right? Their accident rates are much lower than the 40,000 highway deaths we have each year. So I could go on and on, but the bottom line is there's just these huge benefits of AI saving lives. At the same time, I would say on the negative side, I'm at a 5 because we do have some very real concerns. The use of AI by totalitarian regimes, the impact of AI on jobs and disinformation. So we have plenty of problems that AI causes as well.
Dr. Etzioni. Sure. Well, welcome. I'm Asit Sharma. I am really excited for this hour. I wanted to go back for a second. So you've had a unique career, as Andy said, as a scholar, entrepreneur, and advisor, an investor in the fields of machine learning and AI. You completed your first machine learning project all the way back in 1988 as part of your master's thesis at Carnegie Mellon. And you've gone on to author literally hundreds of papers in the decades since. But we were curious, can you tell us about that very first machine learning project? How did your journey begin?
Oh, wow. That brings me way back. I like to say that when I started working on AI, most people couldn't even spell AI. And back then, the big question has always been, how do we get the tremendous knowledge that people have, common sense, knowledge about the stock market, knowledge how to open a door, right? Just all these things. How do we get them into the machine? And back then in the 80s, there was a big debate. Some people said, well, we write it down, right? Not in, cursive, but in a formal language that the computer could understand. And there were a set of rebels who said, no, the computer has to learn it more or less the way people do, right? We learn most of what we know from our experience, from stuff we read, and so on. So I was part of the rebels back in '88, and I got into it because I just thought there's so much knowledge that we just cannot afford to type it all into the machine. The machine has to acquire it. Now, fast forward many years, the learning techniques I used are way out of date, but learning has definitely won the day. So all the modern AI systems that we see, whether it's OpenAI or Google or Microsoft, what have you, they're all learning systems using neural networks to acquire knowledge from about the world.
And Dr. Etzioni, when you reflect on where we are today, and you think about the technologies, and then going forward, is there one particular, whether it's in the application of chatbots versus you're so involved in there because you've looked at so many businesses and you've invested in different businesses and run different businesses. I'm curious, when you think about the application of AI, you mentioned driverless cars, which I agree. Are there other things that stand out that really catch your attention these days?
Absolutely. So my colleague Andrew Ng of Stanford said AI is the new electricity. So the first thing to understand before we get into some specifics, and I will in a sec, is just how transformative it is. So take a dart, throw it anywhere on any word in the dictionary, any field, education, healthcare, cars, robots, you name it. Yes, AI is right now transforming that. There are startups. Now, it takes a while. So some of these, particularly in heavily regulated industries like healthcare, it's going to take a while to reach its peak. But right now, in finance, for example, in investing, in regulatory compliance, and things where there's like reams and reams of text that somebody has to read and make sense of quickly, AI is up to that task because it can now really understand language and it doesn't run out of patience or time.
Investing is a great, I mean, like just the amount of things that we are using the different tools for to go through financial statement analysis. I was just doing it this morning, doing some research, and it's pretty, I mean, it's a game changer, really. It's a complete time saver. And I don't know, I don't know if the necessarily the regular consumer on the street is, I still think we haven't seen the adoption of that quite yet. Do you agree with that?
Well, what I'd like to point out, and again, we can spend a little bit of time to unpack this because just AI and investing is complicated. But the thing I want to highlight is I think people may not be aware of the person on the street, the extent that they're already using AI every day. So when they're using, Alexa, speech recognition, that's AI. When they're using a search engine, right, the ranking is done using AI. When you get a recommendation from Amazon or even your Facebook feed, that's all done using AI. So we're using it everywhere. Now in investing, you do need to be more sophisticated. Maybe you need to be a fool to be using AI.
I love the
wait,
Go
Asit,
ahead, Andy. Yeah, please.
Yeah, if I can just, and so why do you, just out of curiosity, why do you say you need to be a little bit more sophisticated on the investing side? Just curious.
Well, the thing to remember, my current favorite definition of AI, right, it's called artificial intelligence, but I like to refer to it as augmented intelligence. Because if you just blindly rely on AI, then you really are a fool. You're the lawyer who submitted a brief to the court to find out that it invented some precedents and he got in trouble and so on and so on. So the smart play is to use the information it gives you to make you a lot more efficient, but to still remain in the driver's seat, if you will, and make your own decisions. So AI is really being used to augment us, to supercharge our abilities, not to take over.
So part of that is really understanding in your domain of expertise how artificial intelligence can help you. And I know on the investing team here at the Motley Fool, we spend so much time trying to understand how different tools can isolate information that's relevant to us to provide us a means to generate insights. And you have a very fascinating paper that I wanted to ask you about that's somewhat related to this. It's called A Computational Inflection for Scientific Discovery. You're a co-author on this paper. It has this premise that we can find novel ways to connect the outer flow of information, is what the abstract of the paper says, with what you call the inner cognitive world. I was wondering if you could explain this idea and how the concept works, because it seems like AI is increasingly able to understand how we're thinking as it becomes more efficient at providing information to us and assisting us with insights. It just seems a little related to what we do. I know the model is scientific discovery and how scientists process information and think.
Well, first of all, Asit, you're absolutely making my day because, you write all these papers. You're like, does anybody ever read these? And even to do they remember what we said. So you've read some of my papers and I'm just touched. Let me boil it down to the part that's relevant to investing and so on. There's a ton of information, right, in financials about companies' earnings, manufacturing capacity, what have you. But there's also the mindset of the investor and the mindset of the market. So our observation was that you need AI that ties both. If all you think about are the numbers and you don't think at all about the psychology, that's not going to be successful. And of course, vice versa. If all you think about is, I don't know, meme stocks, people love it, I got to get in, right? But it has no financial basis, right? That can be a problem as well. So the thing that's new and exciting here is these latest AI models like ChatGPT or Claude or what have you are actually able to deliver quite sophisticated, what's called theories of mind, basically models of how people think, how the crowd thinks. And so for the first time, it's able to do both. And that's very powerful.
Has the development and the speed over the last 18 months surprised you or disappointed you?
There's been a ton of surprises, so I don't at all claim to have a crystal ball. But this particular one, if I may brag a little bit, I was not surprised at all. And the reason is that it's from the same playbook. What happens is we build something, we being computer scientists, not even AI people, we build something and then we optimize it. You know, if the internet today was working at the speeds that it was working when it first got started, we couldn't like see videos. We couldn't be having this conversation, right? We don't notice it because we keep upping the stakes. But the fact of the matter is, computer scientists are so good at making things run faster, be smaller, Moore's law, as it's called, right? So your phone has more computational power than the space program had back in the day, and so on and so on and so on. So it's not surprising that not only has the speed gone up, but the speed's got up and the cost gone down. So the cost of accessing some of these sites has gone down by a factor of 10 in the last 12 months. So it's amazing.
Should we believe Jensen Huang when he tells us that there are 3 scaling laws, and the third, in which you're asking a model to reason in steps, is just going to keep pushing the need for computation up, and therefore investing in NVIDIA and its GPU complexes is a great idea?
I would say the following. It is true that the focus has shifted from gathering as much data as you can over the internet, which is, I don't know if it's fully exhausted, but certainly, right, every nook and cranny has been mined, not just text, but videos transcribed, podcasts, etc. So there's this shift to now having models that spend time, and again, it's in quote unquote, thinking or reasoning, but basically doing some computation after you've given the query, and that's very compute intensive. So that part is very true. As to whether one would invest in NVIDIA in particular, I'll leave this to the analysts because, of course, there's the countervailing forces that have to do with other companies playing catch up and with companies like DeepSeek, right, figuring out ways to make these processes a lot more efficient. So you have kind of this, what's sometimes called a variable rates problem, right? You've got this bucket and water's coming in, but it's also got holes in it coming out.
So I have a follow-up question for you on that. I'm a reader of a blog called The Sequence, a really fun way to keep up with the AI industry for lay people like ourselves. And you spoke with them a few years ago. And I want to quote something which is related to what you just said from that interview. You said, research needs to have a healthy respect for simplicity. Many research models are overly complex for the sake of impressing reviewers or for garnering very minor accuracy gains and for scalability to large data sets. So at that point in time, a lot of what we looked for in terms of model evolution was coming out of academia. And I would say there have been like great partnerships between business and academic models. I think Alphabet's a wonderful example of a company that produces great research. But so much has shifted to companies which are in the private sector. How do you see this 4 years later? Is academia still focused on sometimes the beauty of the problem? Are companies still being very efficient with getting to the heart of things? I mean, you mentioned DeepSeek, which has a really great method for analyzing information. How do you see it today?
It's definitely the case that there's been a shift, and we've seen this over the years in multiple sectors. So, for example, operating system, right? There's been a lot of research in academia, but the fact of the matter is the main operating system work is at the big companies, whether it's Linux in the open source community or Windows or Apple and so on. Likewise with search engines, right? Again, there's work on academic search, but the heart of it is at companies, and it has to do with the scale, right? So if you need $1 billion investment just to show up, right, then that's an issue. So certain kinds of research you just can't do in academia anymore. The beauty of it is that the field is more multifaceted than that, and so students, professors like myself are often finding problems that companies may not be in a position to solve in lots of different ways. So I would say that we still have a vibrant ecosystem, but there are certain research questions where, yeah, it just, it's not going to be studied in academia. And that's potentially a problem for how quickly we move, right? Because if there's only limited set of places where you can do certain kinds of research, it's not going to move as fast as otherwise. So I've actually worked with the White House some years ago on creating a national AI research resource, basically a big cloud so that universities can keep up with big companies.
Dr. Etzioni, you mentioned your work as a professor over the years. And of course, as I said, you've done so many different things. I do want to focus a little bit on those who are coming in, students who are coming in to you. And I have 2 young children at home. The oldest, who's 13, is just starting to use a little bit of ChatGPT, and like I said, I use different tools pretty extensively, and so she knows that I use it. How do you think about teaching teenagers into college as they go to university about these tools, how to use them safely, responsibly, but also understand, hey, this is here and it's not going away. It is the horses left that barn. So guidance to parents out there on how to talk to their, say, teenagers or college kids about using AI and specifically chatbots responsibly.
I think you're absolutely right? The horse has left the barn, just say no is not an option. And the parents need to be aware of that with their kids, and the teachers need to be aware of that, right? Initially, when ChatGPT came out, New York public schools wanted to block it. It just doesn't make sense. So we need to evolve and even revolutionize how we teach so that both people have the skills that they need to use these approaches, and at the same time, don't lose key skills like thinking critically and writing. So, for example, at school, I'm a big fan of in-class assignments that are tested and graded where you can't use the machine at all, right? Because there are situations without that, as well as homework where you're not trying to tell them, well, go home, but don't use the best available tools. And if you do, you're going to get in trouble, right? And I'm going to check, even though it's actually very hard to check. I actually think that there are ways to manage that. As far as the parents, the big thing you need to work with your kids on is thinking critically about what's coming in. It's just all too easy to use these tools and get something very profound and very helpful, and in another click get something completely false that's literally on the same screen and the same font, and it's like, oh, well, ChatGPT says this, it must be true. And it can be what's called a hallucination. It can make it up. It can be based on nonsense, all kinds of things. And I think that the most important thing to do, and it takes time, is to actually sit there with your kid as they're interacting with the machine and work through it with them. It's like, okay, should we believe that? How can we check? How can we corroborate this? Okay, that didn't work. How might we change the question we ask the machine, the prompt, to ask it differently? And I think that actually it's fun collaboration, and you learn. Now, again, this should not take the place of going out and playing frisbee with your kids, but don't leave them, quote, to their own devices, right? Pardon the pun. You got to spend time with them working together, you, the kid, and the AI.
Spending time with your kids. I don't know if my kids would like that too much with me. Asit, do you have a follow-up or?
Somehow I think your kids would love to spend time with you, Andy. I'm
Not in that
sure
regard.
you're the world's greatest dad. Well, let's expound on this for a moment, because it makes me think as well. And I have kids who are now in their 20s. The rate of change is just so amazing with AI. I still remember the day I was slacking with Andy and our great colleague Emily Flippen. This was only a few years ago, and I said, Jensen Huang says that one day you'll be able to just talk to machine and tell it to put a fort there in your video game. Now it's hard to envision a world or remember a world where that wasn't possible. We're so quick to accept this. And I was curious, what are your thoughts on this idea of being on device, utilizing these tools so much, even if you employ methods of critical thinking? Are we in danger over time of gradually surrendering our cognitive functions to these machines? Is it possible that we lose our key abilities to produce insights, to think rationally, because the tools are such a crutch and it's so easy to revert to them? So many of us who now use this in our workflows are using them a lot for uses that we didn't even imagine when we first heard this term, like ChatGPT or Claude, large language models.
I feel like you're asking, both of you, really great questions, and I keep answering them the same way, yes and no. And it is just two sides to this coin because it's so broad. So again, let me start with the yes part. We have seen people when they take in disinformation and misinformation, when they become ditto heads in various ways, where they're just seduced by all this information on social media, where they really are surrendering their critical thinking and are being just too credulous. So the answer is yes. It's quite dangerous, and again, that's why it's important to have organizations like Motley Fool and others to discriminate the wheat from the chaff, right? We have to, some people say, oh, the authorities are going to go away. Far from it. When you're drowning in information, right, you're starving for wisdom. You need people who can help you do that. So that's the yes part. The no part is, I think that over time, people's discriminative ability will emerge. So basically, every time there's a new technology that's powerful, take search engines. People are like, Henry Kissinger was famous for saying, Google, it's terrible, right? People aren't going to remember anything. And it's actually a lot more complicated than that, because Google is a very useful tool. And we did not lose our sense of history and so on, but maybe we didn't have to memorize as many dates and kind of annoying little facts. I don't have a great memory, so I love search engines. So the fact of the matter is that if you cede too much to the machine, you find that the quality of the product just isn't as good. And I think the best way to see that, and this is what I advocate to everybody, is to do what it sounds like you guys are already doing, which is use it in your work. Don't just play with it and be blown away. Oh, summarize for me, Polish history in 15 sentences in iambic pentameter. Okay, it'll do that and it'll be amazing, but like, you can't even tell. I'm not an expert on Polish history, right? So where I'm going with this, when I use it in my work, in something where I really need to get something done and I'm an expert, I also see a bunch of the warts. I see where it falls short, where it makes mistakes. So these tools, they're powerful, but they're not a panacea. We still need augmented intelligence.
Dr. Etzioni, you've done a lot of work in just studying deep fakes and understanding that part of the market. And with that comes some thinking on regulation. And I'm just curious your thoughts on quote, I'll put it in quotes, quote, regulating AI, whether it's in the US or whether it's over in Europe or around the world. Just share some of your opinions on should we a little, should we a lot? Where do you stand on that?
I think that regulation is something to do very carefully, because it's so problematic. And let me explain why. I like to say that the road to regulatory hell is paved with the EU's good intentions. So they're at the vanguard of regulations, and they've gotten it wrong so many ways. And we can go into examples, but basically it's overregulated, which slows them down. And there's a reason why the innovation is here. At the same time, if we have no regulation, if it's a complete free-for-all, then there are certain problems that arise. So the question becomes, how do we have good regulations? And it's hard. It's hard because of regulatory capture, right? When we've seen again and again, when there's technology, the regulations that come out have been shaped by the large companies that have the most successful lobbyists, right? Which is not the basis of great regulation. But at the same time, if you don't do anything, then cities and counties and states will regulate. So self-driving cars is a great example, right? We need a single federal set of regulations. We don't want California to look different than Kansas. That's problematic for everyone. Now, how do you get there is a long and complicated road. So I would say that I'm for good regulations that are done very judiciously, and that's a hard goal to achieve, particularly with fast-moving technology like AI.
And just a quick follow-up, how do you feel we're doing identifying deep fakes, working through that system, navigating that kind of world?
I dedicated the 2024, a year of my life, to a nonprofit called TrueMedia.org that I founded to fight political deepfakes all over the world, right? The 2 billion people went to elections in India, in Indonesia, Brazil, and of course the US. And the issue became somewhat politicized, but it's not actually a political issue. Nobody wants to be duped. And we now have the technology to create videos and audio and images that trick you. And so it's an important problem. It's far from solved. Regulation won't solve it, and we need to get better at it. And again, I can go into more detail, but the one thing I tell you is don't necessarily believe what you see. Make sure that you know the source, that you know that it's a bona fide, even image. And maybe now is not the time to tell you, but actually, this isn't me. This is no, just kidding. This is me.
Yeah, I should have asked that when we started. That was my mistake. Are we really talking to the Dr. Oren Etzioni?
And Dr. Etzioni, you're so good at this. I almost wonder maybe this is the AI version. But
the AI version is not this good. Awesome.
Not this good. That's how it works.
Well, you're very kind. But I think many people have heard of this, but not everybody, right? There was this finance executive last year who wired something like $25 million out of his company based on a Zoom call with the key executives in his company. So they had it down, right? They had their email addresses, they had their accents and so on. So, for example, our family has passwords because they've been simulated kidnappings and so on. So if I'm talking on the phone to one of my kids and I have any reason to suspect, right, I bring up the key question, and this sounds like cloak and dagger, but hey, then I know it's really him. So or another example, my broker, they were using audio to authenticate me, and I said to them, wait a minute, how can you tell it's really me? And they're like, oh, sir, we use AI. And I said, that's the problem. And I turned it off. I said, no, we're no longer going to use audio to authenticate me. You just, it's a major problem.
It's funny. My wife received one of those calls in relation to our kids. So that's a prevalent scam, and what a good practice that we can employ. So I want to ask a general question on behalf of one of our members, Pro Shop Guy, who actually is a colleague who works on Fool24. He asks, what recommendations do you have for ensuring that we get the best version of AI for everyone's benefit? What is the balance of getting all stakeholders involved?
The first thing to realize, again, I could speak about this for an hour or so, but I'll just make 2 points. The first thing to realize is that, amazingly, this very sophisticated capability is free, right? You can use the ChatGPT free plan. You can go to Google. I'm not partisan across these different companies, and you can use this amazing capability for free. That's huge. That's a huge enabler. Even if you're homeless or unhoused, if you go to the public library, if you have access to the internet, you can leverage AI. In the developing world, right, where people don't have access to the same resources that we do, whether it's in mental healthcare or in information, they have access to this. That's amazing. That said, there's definitely a concern about how it enhances inequality. And we need to consider, right, does AI exacerbate the power of capital? So I would say, again, there's the great thing, and there's definitely a concern there as well.
What is the Dr. Etzioni opinion on AGI? Are we on that path? Are we closer than most people think? There's been lots of very smart people have talked about how it's around the corner. Some have said, no, it's decades away.
My favorite quote about this is, never mistake a clear view for a short distance. And what it means in this context is that for the first time, maybe, we can see clearly the emergence of AGI, artificial general intelligence, basically human level intelligence. But at the same time, no, we are not near. It's not coming next year. It's not coming in the next 3 years. And we've seen time and time again overly optimistic predictions. I think that it's likely to emerge over the next 20 years or so, 20, 25 years. And it still won't be perfect. We still have a lot of problems to solve. But in the near future, it's not like we're going to have AI. And you're right, that is somewhat controversial now. It's not just kooks who are saying AI is around the corner. Some people who are very, very smart and knowledgeable are saying something different. So I could be wrong, but everything I see technically tells us we still have a lot of problems to solve.
And do you want to just give a quick follow-up? Just give your definition of artificial general intelligence. How would you know that we're there?
Artificial general intelligence is when the machine can do what's called cognitive tasks, basically things that we believe require intelligence, whether it's to play chess or to write a document or make a good investment decisions. The G there is for general, right? So we already have machines that can do any of these narrow things very well, like play chess better than any human, or Go, or what have you. But the general stuff, we still struggle with quite a bit, and it can do some things really well, but it's brittle. You ask it a question, it gives you an amazing answer. You ask a follow-up questions, and it gives you the most boneheaded answer you've ever seen. And you're like, what planet are you from? So the brittleness of it, the fact that it struggles to not hallucinate and just make random things up, is some of the places where it continues to fall short.
So Dario Amodei, who's, as you know, the CEO of Anthropic, has a lot of vision about the future and how AGI can benefit society. I have a twofold question for you. The first is, one of the visions he puts forward is that a reasonably intelligent artificial intelligence could be put in control of the means of production. So an AGI could control a factory and produce things at scale, or it could use tools to actually do science. So right now we think of having a transformer mechanism, look through data sets, and maybe come up with some innovative molecule. But he posits that the actual machine itself could have control over those tools. Do you think that is something that's viable or going to come anywhere near into the future? And then I've got a quick follow-up.
You're bringing up a really important point that a lot of people misunderstand. And I feel like this is the most important thing I'm going to say today. So let me just take a few extra seconds to say this. We often confuse, mix up intelligence and autonomy. Basically, autonomy is power. And we people, right, who are very powerful, often very intelligent, often gain a lot of power. And so we naturally see these things as going hand in hand because that's how it works with people. With machines, it's very different. If you take ChatGPT, in some ways, one of the most intelligent programs ever built, and you ask it, hey, ChatGPT, what do you do between queries? The answer is nothing. I just sit there, wait for the next query. So is ChatGPT powerful? No. Does it have autonomy? No, it just sits there, right? Likewise, with these more sophisticated systems. The reason that's important is we can build over time AI systems that can do very, very sophisticated things, but people will and should remain in charge. And so some of these visions, like the ones you're describing, assume that once we have these intelligent machines, we're not using them as tools, they're using us. And I think that's a misconception. And the example I love to give to just drive this home is we're on the verge of having self-driving cars in many, many places. As I mentioned, we already have them in several cities. It's the case that the car decides when to hit the brake, when to hit the gas, and all that to keep you safe. But it's not like the car decides where to go. It's not like I get into the car and I say, hey, I want to go to Dunkin' Donuts. And it says, oh no, Oren, it's the second time this week. I'm taking you to the gym. That's not how it works. You still decide where the car goes. And that's the way it needs to be with AI.
So Karl asked a question.
Go ahead.
Oh, sorry, Asit, do you have a follow-up?
A brief follow-up, yes. So, okay, what I'm really curious about, and you're an expert in machine learning among so many other things, if we look forward to this future where we do have artificial general intelligence, will it really be able to solve problems? It seems to me that so much of AI is based on optimization functions, so making things that are really probabilistically correct. And the human brain is so good at seeing things that come out of left field, or just, happening to have something that's in your consciousness that gets related to something else. And then we have breakthroughs. Why haven't we seen as yet and not just the 3 years where most of us have been using things like ChatGPT, but in the years before, why have we not seen a major scientific breakthrough from the machines?
I love that question because my colleagues at the Allen Institute for AI are actually working on machines for scientific discovery as per the paper that I wrote a while back that you mentioned, which is there. So you're right that it's important and valuable, and you're right that we haven't quite seen it yet. It has to do actually with taste. It has to do with the fact that you can generate actually an enormous number of scientific advances. Most of them are completely uninteresting. Think of it, you can generate all these new molecules, right? But most of them are like, they're hard to produce. They don't help anybody. So what's the point? It turns out that we still have a very strong, I don't want to call it monopoly, but a very strong advantage in taste, in knowing what's important, what really makes a difference. And so science requires a lot of taste, as by the way does art. So if you tell it to copy Picasso, it can do that very quickly. If you tell it to mix Picasso and Van Gogh, it'll do that very easily. If you tell it to produce art, it'll produce 10,000 paintings in a few seconds. But if you tell it to produce beautiful art that's new and exciting, all of a sudden it's like a colleague of mine said that the music that AI produces sounds like wet cardboard, right? It doesn't have taste.
Wet cardboard, something, yeah, does not sound attractive.
Exactly.
Dr. Etzioni, Karl asks, Oren, what is your reaction to OpenAI's virtual employee offering leaked from investors $2,000 to $20,000 a month for virtual knowledge worker or research employees? So some quick background for those who may not know. The information leaked that apparently OpenAI is planning to charge up to $20,000 for specialized agents, including PhD level research, according to this leaked memo. So I have two parallel questions, Dr. Etzioni. Is one, just thoughts on agentic AI? There's been so much conversation from different businesses and entities talking about agents, and clearly here is OpenAI talking about it, and then specifically about this Karl's question about this leaked memo from OpenAI around very expensive, but perhaps very powerful. I mean, at least the one PhD I'm talking to right now is extremely smart, so that could be worth a lot of money.
Agents are coming. A lot of people see 2025 as the year of agents, and again, some have been released. Most of them don't work so well. So the current agents, right? There's Operator. There's various ones out of that's out of OpenAI. There's various ones out of Microsoft. They still have a ways to go. So I also work at the AI2 incubator in Seattle. We're seeing a lot of early stage startups that are funded to create agents that automate various workflows in a variety of industries. So this is definitely coming. The only thing we really know about this quote PhD level agent out of OpenAI is they're planning to charge a pretty penny. Was it $20,000 a month for it? And I have to call bullshit here. Okay, they may charge that, but I pity the people who will pay that, because I do not believe that in any kind of broad scenario. Sure, you can always hack something very narrow. I do not believe that we're going to see the proliferation of agents worth $20,000 in 2025. I'm here on the record. You can show me to be wrong, but no way.
Because you did say, I mean, we have been using some versions of AI agents, when you go to your cable provider and maybe ask a question, go online, like all of those kinds of things to some extent. But this clearly, as Karl was referring to, this leaked memo is that this takes it to another level if indeed they are claiming this.
Exactly. So customer service, right? Yeah, that's an industry that's under siege. And actually, again, there's good news and bad news. Bad news if you're in customer service. Good news if you don't like to be put on hold, or you don't like this phone menu hell. Press 3, right? That is on the verge of getting actually a lot better. But again, and it's not so much the PhD. Forget it's a PhD or not. It's just replacing folks that get paid $20K a month, right? That's a very healthy salary. We're just not there yet. A big thing is with coding, right? People have been talking about, software engineers are going to become obsolete. No, they're not. It's a complex job. You need to make sure the software works. Sure, it can produce code, especially for things it's seen 1,000 times before. It can help. It's a productivity tool. A lot of the software engineers I work with are using it. But no, software engineers are going to be in demand for the foreseeable future.
Yeah, it's that last mile, I think, where the human really comes in mind. Asit.
Dr. Etzioni, speaking of creating value, real value, you are involved in a new venture, and we'd like to ask you about it, but you may not want to reveal much because I understand your new startup that you've just joined as a co-founder is operating somewhat in stealth modes. If you can give us an overview of what you're doing, that'd be great. And if not, we understand.
Well, really appreciate your asking, because obviously new startups is called Vercept.com. Not exactly a name that rolls off the tongue. Love visibility, and we're hiring and all that. And I did check with our CEO. I'm not the CEO. What I'm allowed to say, and she was very clear. She said, "You can't say nothing." So it's an AI startup in stealth mode, and we will reveal things in the coming month. But it pains me, but my lips are sealed.
No worries. So let me just ask you an unrelated follow-up, but in the same vein, can you tell us about A12 and what they seek to achieve, how they seek to help the AI industry?
You mean the Allen Institute?
The Allen Institute, yes.
Right. There's also there's so many of these things. So very quick backstory. The late Paul Allen, co-founder of Microsoft, reached out in 2013. He wanted to create an AI institute. That's his namesake. It's a mouthful, the Allen Institute for AI. So we just abbreviated to AI2. And I ran it until a couple of years ago. Now somebody else is running it. The key thing is we believe in this ecosystem that there's also room for nonprofit research institutes. So it's a nonprofit focused on open source. It actually has its own version of LLMs, right, like ChatGPT, but open, so people can build on top of it. And also, like you mentioned, with scientific discovery, it's doing research to do that. So the mission was always AI for the common good. And of course, it's led to a bunch of technologies that's used by all kinds of startups. That's what led to the AI2 incubator, which has spun out. So we've created now, if you look at the market cap of the companies, easily more than $1.2 billion of various startups, right? That's their market cap. Some were acquired by Apple, by DocuSign, Thomson Reuters. So a lot of cool stuff is coming out, and the beauty of it is publicly available. So you just go to the website and you can see the papers, the open source. It's not all secretive.
Dr. Etzioni, on that, like I said earlier, you've been involved in different businesses and the tech startup area for decades, and I want to ask a couple of different questions about that journey. But first, I want to start off with: are you seeing any parallels with the late '90s, early 2000s that we went through as investors and as citizens to where we are today? So that back then was internet, lots of different innovations, outstanding stock market performance, little bit of a bubble that ended up popping, to where we are now in AI. Are you seeing any do you draw any parallels with those two markets, those two times?
I think there's an excellent parallel, and you highlighted 2 points, and I'll add a third. So first of all, transformative technology. Secondly, some winners and some losers, but overall, literally trillions of dollars of value being created, right? So Amazon, and I still remember this back in the day, Amazon used to be controversial. People used to call them Amazon.com or Amazon.org because it was not making any profits. You know what? Nobody's calling Amazon .com or .org anymore, right? It's a juggernaut. So absolutely. The big thing that I would add is that this thing is moving so much faster. So 2 years out of the internet, maybe 20% of people were starting to use the internet. 2 years out of ChatGPT, 40% of Americans are using generative AI, and it's growing very, very quickly. So this trend is faster and more powerful even than the advent of the internet.
Wow, fascinating. Asit, jump in with your question. I do have a follow-up back to all the businesses that you ended up starting and then exiting. But Asit, go ahead.
So this is another member question from Sadaf, and he's asking about inference costs and model training. And I just wanted to put a certain frame on that and to ask you, as we see companies like DeepSeek, which have the constraints, potential, and there's some controversy here, of not having a lot of capital at their disposal, as they have been able to make more efficient models. How do you see that balance playing out? Will we have more of this type of innovation where a company just questions how a model is trained and is able to innovate from there? Or will we flip back to where more computational power is needed, which throws power back into the hands of those who are selling ever more expensive and capable GPUs?
I have a very strong point of view on that. There are some folks whose financial incentive is to say, game over, right? We've got the most GPUs, we've got the most this, that, and the other thing, the most data, we've won. And nothing could be further from the case, right? So with on-device things, with what DeepSeek did, with specialized models, with all kinds of trends we don't have time to go into. There are many ways that startups, that small players, that innovative players, that open source players are going to be winners. It's wonderfully competitive. It's internationally competitive, and so on. Now, there are, of course, NVIDIA, for example, or Microsoft, right? They're going to collect their $1 trillion or more, right? I'm not saying that, right? They're already making lots of money, but this is not a game over scenario by any means. And I'm sorry, there was another piece to your question. I'm not sure if I addressed.
No, I think you did. What I was trying to get at is, and I know here we've had a lot of discussion at the Motley Fool about the actual cost to train the DeepSeek model and the inference involved. And some believe that, well, really it's very expensive. But I was looking again at the paper with the help of ChatGPT, because I'm not a scientist. And really the methods that are in that paper, I think are novel, and they really come at the idea of model building without the weight of assumptions. So even if they had a lot of capital at their disposal, even just reading what they did, seems to me to open the door for other companies to challenge the assumption that you need all this money to make a more efficient model. And this is really the what I'm trying to get at to in the question.
You do need substantial resources, right? So there's a reason why, new players like Elon Musk's XAI raises billions of dollars and so on. It's not like, I think some of the figures like, oh, it's 5% of the cost, what have you, may have been a bit overstated. That said, right, when things are dropping by a factor of 10 each year, and if you're working, let's say you're doing distillation, taking the results of a bigger model and moving them into a smaller one, which is part of what DeepSeek apparently did, and so on, you can get away with smaller resources. So what you don't need is to burn through billions of dollars every year, which OpenAI seems to be doing. But at the same time, I don't think I can, take some of my grocery bills or take even my, super high-powered laptop and just say, you know what, I'll do just as well with my laptop. It's easily in the tens of millions, if not hundreds of millions of dollars to train some of these highly capable models. But the good news is that a lot of these models are available via API, and then, of course, via open source. One of the biggest things about DeepSeek is that it's all open sourced, right? So everybody in the technical community is pouring over their papers, their code, adapting it, learning from it. And so to me, DeepSeek is a wonderful development for the technical community.
I think you moved a lot of your True Media to go open source after you kind of wrapped it up, right?
That's exactly right. As a nonprofit, we invested in having a live service, but now our models are open source. We collected a bunch of data that we're making available to people, not to people trying to generate fakes, but to people trying to fight them. Absolutely.
That's right. Exactly. Just to follow up to that, to your entrepreneurship and your starting and selling business, any lessons that you took away from any particular ones that you started and then ended up selling to larger entities, or any learnings really from your last 30 plus years of investing in starting and investing in businesses that you've experienced and can speak to?
I would make 2 points. One is everybody sometime in their career, hopefully relatively early, right, before you have 2 kids and a mortgage and so on, ought to do a startup. We hear so much about what's broken in our society. The entrepreneurial ecosystem is vibrant, it's exciting, there's capital flowing, there's opportunities, these disruptions. I get absolutely giddy when I talk about it. So if you haven't done a startup, what are you waiting for? And you should talk to your kids and their meetups. There's so many opportunities there. That's the number one thing. The number two thing is you have to be cognizant that most startups fail. It's not like, oh, this is the guaranteed road to riches. But even when the startup is not as successful, it's not the next Google, it's not the next NVIDIA, it was such a great experience. The team coming together, the learning that we achieved, how we applied it in the future. So people talk about, oh, startup, that's risky. If you have that flexibility, and if you're young, you should have that flexibility. The only risk is to not get into a startup and then to look back when you're older and say, I could have been a contender. So what I tell people is start something, go for it.
That's brilliant. Asit.
It's so inspirational. And even when you're working within a company like ours, it's inspirational to hear that we can all adopt that entrepreneurial mindset. So I have a question. Speaking of entrepreneurialism and science, this is from Kent, one of our members, who says, what role does quantum computing play in the advancement of AI? And I would almost ask vice versa as well. What role does AI play in the advancement of quantum computing? And he notes that Jensen Huang mentioned that quantum development is a few years down the road. Your thoughts?
Yep. Again, don't mistake a clear view for a short distance. Quantum computation is coming, but it's even further away. Having practical quantum computation, which would really be, cracking our encryption schemes and doing some computations that now take years and years to do in a matter of seconds. We are a ways off from that. We are seeing some exciting innovations. It's not yet practical. So a way to put it in the context of your question, AI is going to help quantum because we're going to use AI to make advances much sooner than quantum is going to help AI.
A question from Mac, Dr. Etzioni. What do you see as the most underrated threat when it comes to AI? And what do you see as the most underrated opportunity when it comes to AI?
I think people are not thinking enough about what happens with autonomous weapon systems. So we're focused on economic, but there are major national security implications, right? We're already seeing drones and how they're used and so on. So we really need to think very hard about how AI is being used in weapon systems. And again, it can be used very positively. There's a startup that I'm super excited about that works on weapon detection using AI. This is in the context, right, of policing. So imagine, right, if you're approaching a suspect and they may be armed, that's a very dangerous situation for everyone involved. What if you could use AI to detect whether they've got a gun, whether they've got a knife, right? That's super, super powerful. So many applications here, but we really have to think about weapons and national security. That's a risk. On the opportunity side, so much opportunity to save lives. So I mentioned 40,000 highway deaths each year, 2 million accidents on our highways each year. We can really reduce that. How about the medical system, right? Costs are going up. Third leading cause of death in hospitals is physician error because they're overworked, right? The system is under so much pressure. AI can help here. So I would say the biggest opportunity that AI presents is to save lives in the near future.
That's excellent. Thank you. And as we wrap up here, we have just a few minutes left, Dr. Etzioni. Thank you so much for being so generous for your time. I want to leave on looking forward. So as you're looking ahead, what is the one big thing that you're looking forward to that we should really keep on the radar as we continue to study and learn more about AI?
I'm really looking forward to how AI can make each and every one of us more effective at what they do. You know, of course, it represents a risk for artists, recording, and otherwise. On the other hand, I can't draw to save my life. I can't do illustrations. And now I'm writing a children's book that's going to be beautifully illustrated with an AI system, right? So many places. You know, I have a terrible sense of direction, but now I use GPS systems. So we are going to become so much more empowered in what we do in so many new and surprising ways. Writing a book is going to be so much easier. Just so much there is to look forward to. Oh, you're muted.
Oh, do we have any? Also, you have any quick follow-ups before we wrap it up?
I think my only follow-up to that is in terms of play and fun, because some of the things you just noted made me think of this. What's the most fun you've had using a large language model or AI, something that we might not have thought that you would be up to?
I've had a lot of fun role playing with it, like practicing for a meeting or a negotiation and kind of seeing the surprising things that it says that it does. But I'm also a huge advocate, and this is a good note to end on. When it comes to fun, I also like to unplug. So the most fun I've had with AI is turning the AI off and going outside and playing frisbee or basketball with my kids.
Amazing.
That's outstanding. Can you just elaborate a little bit more on the book that you're working on?
Oh,
even if it's just for fun.
It's just a little children's book based on stories I told my kids when I was younger, and I had a really hard time finding an illustrator. They're in big demand to illustrate it with the pictures I had in mind. And now I'm using AI tools to create the illustrations. And again, I'm going to publish it for free. This is not like meant to be a bestseller. But the point is, I can do that because it's so inexpensive to create such high quality illustrations. And again, I don't want to take anybody's job, but I tried to find an illustrator who would work with me on this at a reasonable price, and I literally couldn't. Finding an illustrator is almost as hard as finding a plumber, and we all know how hard that is.
That's outstanding. Dr. Oren Etzioni, thank you so much for joining us today in a Motley Fool conversation. We wish you all the best with your new startup, Versep. We are excited to learn more about that and what you're doing. And thank you for all your contributions. And we wish you all the best on that, and also on the success as an award-winning children's author future. So the next time you come on, I will add that to your bio.
You're very kind. Real pleasure to talk to you both. Take care.
Thank you so much, Oren.
Thank you.
Appreciate it. Thank you, Fools.